Please like, share, and subscribe. Wishing you happiness and good luck every day.
Have you ever looked around and just wondered why some of the absolute smartest people you know are just terrible with money? Or, on the flip side, how someone with basically no formal education can end up a multimillionaire? It's this huge puzzle, right? We're always taught that finance is all about math, spreadsheets, and complex formulas. But the truth is, it's a lot weirder and a lot more human than that. To really get it, we need to look at two completely different stories.
Okay, so let's look at two guys who are the perfect example of this. First, you've got Ronald Read. He was a janitor and a gas station attendant for his entire life. Super humble guy. When he passed away at 92, people were shocked to find out he'd quietly built up an $8 million fortune. Then you've got Richard Fuscone. This guy had it all. Harvard MBA, top executive at Merrill Lynch. He was even in one of those 40 under 40 lists. But he borrowed a ton of money to fund this massive lifestyle, and when the 2008 crash happened, poof, it was all gone, wiped out, bankrupt.
And that right there is the heart of it all. See, financial success isn't a hard science. It's not like being a brain surgeon where the smartest person in the room has a massive advantage. You can't just memorize formulas and expect to get rich. It's a soft skill. And the thing that made all the difference between the janitor and the Harvard exec, it wasn't IQ points. It was behavior.
All right, so here's what we're going to cover. First, we'll dig into why smart people make such foolish choices. Then we'll look at what is actually going on inside our brains when we deal with money. We'll explore the two big dangers, greed and risk, and then we'll uncover the real secrets to building wealth, time and tails. And finally, we'll talk about what all this money is actually for, and the answer is freedom.
All right, let's dive into our first big idea. Smart people, foolish choices. Think about it. In almost any other part of life, whether it's building bridges or performing surgery, the person with the most education and the most training is going to come out on top. But finance is a different beast altogether. It's one of the only fields where your personality and your personal history can completely crush a fancy degree.
And this is what's so wild. It just goes against everything we're taught. We think we need to understand all these complicated market theories or memorize tax codes, but a janitor like Ronald Read proved that's just not true. All he needed was a few behavioral skills, patience, a little bit of discipline, and just thinking about the long run. You can have a financial genius who can't control their emotions, and they can be an absolute train wreck. But an ordinary person who just masters their own behavior, they can become incredibly wealthy.
Okay, so if behavior is the key, then we've got to understand what's going on in our heads. That brings us to our second stop, your brain on money. Let's pull back the curtain on the hidden forces that are really pulling the strings.
I mean, you see it all the time, right? People going into massive debt for a car they can't afford. Or people who panic and sell all their stocks right at the bottom of a market crash. From the outside looking in, it looks totally crazy. But here's the core idea you have to get. No one is crazy. Every single financial decision a person makes, no matter how irrational it looks to you, makes perfect sense to them in that moment. And here's why. The things you've personally experienced with money are a much more powerful teacher than any textbook. If you grew up during the Great Depression, you were going to think about risk in a fundamentally different way than someone who got their first job during the 90s tech boom. What you've lived through just feels more real, more true than any chart or statistic. Your personal history is a tiny sliver of what's happened in the world, but it probably makes up, 80% of how you think the world actually works.
Now, on top of all that, you've got these two huge forces that we just don't talk about enough: luck and risk. You got to think of them like siblings. They're two sides of the exact same coin. They're just the reality that not every success story is a result of hard work, and not every failure is because of laziness. Sometimes, stuff just happens that is completely out of your hands.
Get this. This is maybe the best story to explain it. Back in 1968, there were about 300 million high school-age kids on Earth. Bill Gates happened to go to Lakeside School, one of maybe a handful of high schools in the world that had a computer. That's a 1 in a million shot of pure luck. But he had a best friend, Kent Evans. Just as smart, just as driven. They were going to take over the world together. But Kent died in a mountaineering accident before they even graduated. That was a 1 in a million tragedy of pure risk. Exactly the same force, same crazy odds, just pointing in opposite directions.
When you really get that, it should make you a little humble. But it often doesn't. And that leads us right into the twin dangers that can trip up even the absolute smartest people out there: greed and risk. These are the behavioral traps that can tear down a fortune just as fast as it was built.
This, right here, might be the single hardest skill in all of finance: learning how to get the goalpost to stop moving.
It's the danger of always wanting more. I mean, think about Rajat Gupta, CEO of McKinsey, already worth $100 million. Or Bernie Madoff, who is already running a hugely successful, legitimate business on the side. They had everything. They had more money than they could ever spend. But it wasn't enough. They risked what they had and needed for something they didn't have and absolutely did not need. They had no sense of enough, and it cost them everything.
And what's driving this crazy desire for more? It's social comparison. It is a game you just can't win because there's always another rung on the ladder. The rookie ball player making $500,000 a year feels broke next to the superstar making $36 million. But that superstar feels broke next to the hedge fund manager pulling in $340 million, and on it goes, all the way to the top. The only possible way to win that game is to just refuse to play it.
And that brings up a really, really important point. Getting wealthy and staying wealthy are two completely different things. They require opposite skills. Getting money usually means taking risks, being optimistic, putting yourself out there. But keeping it? That takes humility, it takes a little bit of paranoia, this constant awareness that things can go wrong, and you could lose it all just as fast as you made it. The legendary trader Jesse Livermore made a fortune betting against the market in the 1929 crash, but he lost every penny a few years later because he never made that mental switch from getting rich to staying rich.
Okay, so we've talked about all the traps. So what's the solution? How do you actually win this game? Well, the principles are actually pretty simple, and it all boils down to two big ideas: time and tails. These are the forces you can actually put to work for you. Just look at this number, $81.5 billion. That is a staggering amount of money. What do you think that is?
Well, get this. That's how much of Warren Buffett's $84.5 billion net worth he earned after his 65th birthday. Almost all of it. People go crazy studying his investing strategy. And yeah, of course, he's a brilliant investor. But his real secret, his superpower, it's time. The guy started investing when he was 10 years old and just never stopped. That is the mind-bending, reality-warping power of compounding.
All right, secret number 2 is this idea called tails. The basic idea is that a handful of things account for, well, most of everything. A few huge events are responsible for the majority of the outcome. Think about a venture capitalist. They might invest in 50 different companies. 49 of them might go to zero, completely fail. But one of them turns into the next Amazon. And that one massive win, it pays for all the losses and then some.
And here's the crazy part. This isn't just for some Silicon Valley startup investor. This is how the entire stock market works. If you look at the whole Russell 3000 index, you see the exact same thing. 40% of the companies in it were catastrophic failures. They lost almost all their value. Most of the rest were meh. Basically, all of the market's gains came from just this tiny 7% of superstar companies. The lesson is, it's totally normal for most of your bets to not work out, as long as you have a few that work out spectacularly.
So, all of this leads to one big final question. We've talked about how to make money, how to keep it, all the psychology behind it, but what's the point? What's it all for? And that brings us to our final section, the ultimate dividend. And that dividend is freedom.
This quote from the psychologist Angus Campbell just nails it. He spent his career studying what makes people happy, and he found that it wasn't their salary or the size of their house or how prestigious their job was. The single biggest thing that correlated with happiness was having a strong sense of control over your own life.
And that, my friends, is the real dividend money pays. It is the greatest thing your money can ever buy. It's not the fancy watch, it's not the sports car, it's control over your time. It's the ability to wake up one morning and just say, I can do whatever I want today. It's having enough of a cushion that you can afford to wait for a great job instead of having to take the first mediocre one that comes along. It's being able to take a week off when your kid is sick without worrying about your paycheck. That kind of autonomy, that's the real wealth.
So I want to leave you with this, something to really think about. As you go about your own financial life, your job, your spending, your saving, ask yourself this question. Is your money working to buy you more control over your time? Is it buying you more freedom? Or are the things you're buying and the lifestyle you have to maintain actually costing you that very freedom? It's probably the most important question in the entire psychology of money.
Have you ever looked at someone's financial choices and just thought, what on earth are they doing? Well, today we're going to dig into that exact feeling, because it turns out it reveals something really profound about how every single one of us thinks about money. I mean, we've all seen it, right? You hear about a friend or a family member, or maybe just a story on the news, and they've made a money decision that seems completely illogical, totally irrational. But here's the big idea we're going to explore. What if those crazy decisions aren't crazy at all? What if from that person's point of view, they actually make perfect logical sense? All right, so here's our game plan. We're going to look at why these money paradoxes exist, the tiny slice of reality we all base our big ideas on, how pure chance shapes our thinking, and why we're basically all rookies at this game. And then we'll see how to shift from judging to really understanding. Let's dive in. So, first up, this concept that what we call financial common sense is anything but common. In reality, it's deeply, deeply personal. It's something that's forged in the unique fire of our own life story. Just take a look at this list. Every single one of these things creates a completely different reality. If you grew up poor, you're going to think about risk and reward in a way that the child of a millionaire banker just can't. If you grew up seeing crazy inflation, your gut instinct about saving is totally different than someone who's only ever known stable prices. For you, your personal experience is the undeniable truth. And that is the absolute key here. This isn't about being smart or dumb or who has more information. It's that your own experiences, the things you've seen with your own eyes and felt in your gut, are 1,000,000 times more powerful than any chart in a textbook. It forms your personal blueprint for how the financial world works. So just how much does our own little world shape our thinking? Well, when you look at the math, it is absolutely staggering. Think about that. Every boom, every bust, every market crash, every single innovation that has ever happened in the history of the world economy, and this tiny microscopic number, that's the part you've actually seen firsthand. It's almost nothing. And yet, that tiny, impossibly small sliver of experience, it accounts for something like 80% of how you think the entire world works. This is the big takeaway. We are all forming massive, deeply held opinions based on an incredibly small data set. So what does this 80-20 rule actually look like in real life? Well, let's look at how two different people can live through the exact same period of history and learn completely opposite lessons about money. Check this out. This is nothing but the pure dumb luck of when you were born. If you were born in 1950, you spent your most formative years watching the stock market basically go sideways. Your experience taught you stocks are a sucker's bet. But if you were born just 20 years later, you saw the market explode. Your experience taught you stocks are a one-way ticket to wealth. And here's the thing. Both of those people will argue about it for the rest of their lives. And both of them are 100% right based on the world they actually saw. This quote from JFK is so telling. You'd think an event like the Great Depression would be a universal experience, right? But for him, coming from wealth, it was an academic topic, something you read about in a book. For millions of others, it was a deep emotional scar that dictated every single financial move they made for the rest of their lives. You can read about fear, but you can't learn it from a page. And this shows how we can all be living in different economies at the exact same time. We all heard about the Great Recession. The national news said unemployment hit 10%. But look at the reality on the ground. For a young Black teenager without a high school diploma, it was practically a coin flip, 49% unemployment. That's a full-blown depression. But for college-educated white women over 45, it was a much, much milder downturn. Their view on job security and economic risk will be different for the rest of their lives. Now, zoom out to a global scale, and the differences are even more extreme. An entire generation in Germany and Japan grew up learning that your life savings, your entire market, can be wiped out overnight. So what do you value? Stability, cash. You avoid debt. Meanwhile, in the United States, that same generation learned that the economy always bounces back stronger and taking risks is rewarded. These are deep cultural beliefs about money, born from totally different realities. Okay, but there's another really important piece to this puzzle. It's not just that our experiences are different from each other. It's that the entire system we're trying to navigate is brand new. It's practically an infant. We treat ideas like retirement planning and 401ks and index funds like they're ancient wisdom passed down through the ages. We beat ourselves up for not being experts. But the honest-to-God truth is that as a species, we have had almost no time to get good at any of this. This timeline is just wild. We've had money, actual currency, for over 2,500 years. But the idea that every average person is responsible for funding their own retirement, that's barely been around since our grandparents' time. The 401k, that didn't even exist until 1978. The Roth IRA came along in 1998. We are all truly the first couple of generations to ever have to deal with this stuff. We're winging it.
This analogy just nails it. Think about it. We've spent something like 10,000 years domesticating dogs, and they still have wild instincts. They still do things we don't understand. Yet we've had this modern financial system for maybe 50 years at best, and we expect ourselves to be perfectly adopted, completely rational robots. It's an absolutely absurd expectation. We're not crazy, we're just newbies.
So, what's the point of all this? Where do we go from here? The real goal is to try to shift our mindset, to go from quickly judging someone's crazy decisions to trying to understand the logic behind them. Let's look at a classic example.
Okay, on the surface, this data just looks completely irrational. The people with the least money are spending 4 times more on lottery tickets than people with the most. And here's the real kicker. That $412 they're spending is about the same as the $400 emergency that almost half of Americans say they can't afford. From the outside, it looks like a terrible, self-defeating choice.
But let's apply our new lens. Step 1 is the easy judgment. What a waste of money on something you'll never win. But let's look at step 2, the reality for that person. For them, saving an extra $400 isn't life-changing. It doesn't get them a new car or a down payment on a house. It doesn't move the needle on their biggest dreams. So you get to step 3, the justification. They aren't paying for the odds, they're paying for the dream. For a couple bucks, that ticket is a tangible object that represents the hope of a completely different life. And this is the whole point. This is the mental shift we're aiming for. It's moving from that place of snap judgment to a place of empathy. It's the ability to say, you know what? I would not make that choice, but looking at the world from your perspective, I think I can understand the logic that got you there.
So I'll just leave you with this question to chew on. Think about someone in your life, a friend, a parent, a partner, whose financial decisions have always baffled you. Can you take a step back and try to imagine their story, their unique history, the experiences that might just make their crazy decision make perfect sense?
Welcome to The Explainer. Today we're diving into these powerful, often invisible forces that shape our lives and our fortunes: luck and risk.
And let's just start with this core idea from NYU professor Scott Galloway. You know, it's a simple sentence, but it perfectly sets the stage for everything we're about to unpack about success, about failure, and the stories we tell ourselves about both.
So, here's what we've got on tap for this explainer. First, we'll get on the same page about what we even mean by luck and risk. Then we're going to explore this really powerful case study that you've probably never heard. After that, we'll dig into why it's so hard to learn from success stories, and we'll wrap it all up with some clear, practical takeaways.
Okay, let's jump right into this first section. We really need to lock down this central idea, because honestly, it's the foundation for everything that's about to follow.
This right here is the key concept. Luck and risk. They're siblings. They're two sides of the same coin. You really can't believe in one without equally respecting the other. And they both stem from the same fundamental truth. The world is just way too complex for your actions alone to determine 100% of your outcomes. It just doesn't work that way.
All right, so to really make this idea hit home, let's look at one of the most famous success stories in modern history. But we're also going to look at its parallel story, the other side of that coin, which I'm willing to bet you've never heard before.
The story of Bill Gates' incredible success really begins with a series of just wildly fortunate events. The odds are, well, they're staggering. Let's just start here to get a sense of the scale. Think about it. Back in 1968, there were over 300 million high school-aged kids on the entire planet. Okay, so let's start narrowing that down. Of those 303 million kids all over the world, only about 18 million of them lived right here in the United States at the time. Right away, we've gone from a vast ocean to a, pretty big lake.
And now we zoom in even further. Of those 18 million, just 100,000 of them lived in the Seattle, Washington area, which just so happens to be where a young Bill Gates was growing up. See where this is going? The odds are getting steeper and steeper.
And this is where it gets just mind-boggling. Out of that 100,000, only about 300 of them attended one specific private school, Lakeside. And get this, Lakeside was one of the only high schools in the entire world that had a computer back in 1968. And it was all thanks to a forward-thinking teacher and a $3,000 fundraiser from the Mothers Club.
And look, don't just take my word for it. Gates himself is super clear about this. He fully acknowledges that this was a 1 in a million head start. I mean, yeah, the guy was brilliant and unbelievably hardworking, of course, but he also had a staggering
almost impossible dose of good luck.
But here's the thing. Gates wasn't alone on this journey. He had a best friend, a kid named Kent Evans. And by Gates' own account, Kent was the best student in the class, just as skilled with computers, and he shared the exact same ambitious business mindset. They were, in every sense, two sides of the same coin.
They had it all planned out. They were going to go into business together, be CEOs, build a company. But Kent was struck by the sibling of luck, risk. He died in a mountaineering accident before he could even graduate. A 1 in a million tragedy, the same incredible magnitude of force as Gates's luck, but just pointed in the exact opposite direction.
So, let's move to our next section and see how this all connects. This story, it really highlights a huge problem that all of us face. The line between a bold, winning decision and a reckless, failing one is often completely invisible until long after the fact.
We love to praise success stories, right? We study them, we try to copy them. But what we often fail to see is how easily those same stories could have been tales of just catastrophic failure. The outcomes are wildly different, but the actions themselves, they can be identical. So consider someone like Cornelius Vanderbilt. He built this massive railroad empire by just flagrantly breaking the law. And because he succeeded, because he won, we often look back and we framed his attitude as, visionary and scrappy, the tough-minded captain of industry. But then we condemn others, like the executives at Enron, for the exact same behavior. One story ends in a business empire, the other ends in prison sentences. But the reality is, one got lucky and is now seen as a genius, the other got caught and became a cautionary tale of corporate greed. Same actions, different outcomes. And hey, even the absolute legends struggled with this. The father of value investing, the legendary Benjamin Graham, he admitted this was a problem. The bulk of his entire lifetime of investment success came from a single holding, an investment that, ironically, broke nearly every single rule he himself wrote and taught. Was it skill or was it luck? Even he couldn't tell you for sure. And just think about this more modern example. Mark Zuckerberg is called a genius for turning down a $1 billion offer from Yahoo way back in 2006. But Yahoo was widely called a fool for making the exact same kind of decision when Microsoft tried to buy them. So what gives? One's a visionary, the other's an idiot for doing the same thing. So the crucial question becomes this. If we can't reliably tell the difference between skill and luck, or between inspiring boldness and foolish recklessness, how in the world are we supposed to learn the right lessons from the extreme examples of success and failure that just dominate the headlines? All right, so that brings us to our final section, and maybe the most important one. How do we actually navigate a world where our outcomes are guided by so much more than just our individual efforts? What's a better framework for all of this? I once tried to boil this exact idea down in a letter to my son. Because when you truly acknowledge these powerful outside forces of luck and risk, it has to lead to more humility when you succeed and, just as importantly, more forgiveness and understanding when you, or when other people, fail. So, okay, here are two really practical takeaways. First, instead of trying to be the next Bill Gates, whose story is defined by 1 in a million luck, look for broad common patterns of success that are actually repeatable. Things like thrift, patience, a long-term outlook. And second, just reframe how you see your own journey and the journeys of everyone around you.
It's funny, Bill Gates himself said it best. When you're winning, when things are going your way, remember that you are not invincible. Luck definitely played a part, and that same luck can turn on a dime. And when you're failing, remember that risk is a real, unavoidable part of life. It doesn't automatically mean all your decisions were terrible.
And that brings us right back to where we started. The most important thing to take away from all this is to hold this idea close. Because when we remember that nothing is ever as good or as bad as it seems, it allows for a more realistic, a more humble, and, ultimately, a much more resilient approach to, everything you do. All right, let's dive right in. Today, we're going to talk about a really powerful and sometimes really dangerous idea in finance, and honestly, in life. It's all about the concept of having enough. Seems like a simple little word, right? But getting your head around it, or failing to, that can be the difference between a life of genuine satisfaction and one of complete and utter ruin. So, there's this great story about the authors Kurt Vonnegut and Joseph Heller. Picture this. They're at some crazy, lavish party thrown by a billionaire hedge fund manager. And Vonnegut, kind of nudging Heller, points out that their host, the billionaire, had made more money in a single day than Heller had earned from his masterpiece, Catch-22, in its entire lifetime. And Heller's response? Man, it's just perfect. Yes, but I have something he will never have. Enough. That one line just cuts right to the very heart of what we're talking about today.
And Heller was spot on. For so many people, especially those at the very top, the goalpost for what enough means just keeps on moving. It's this endless hunger for more that pushes people who seem to have everything you could ever want to risk it all. It's a dangerous game, and it often leads to some really tragic endings.
To really get what I mean, let's look at two guys who climbed to the absolute peak of success, only to throw it all away because they just had to have more. Now, their stories are pretty extreme, but the lessons in them, they're for everybody.
So first up, we've got the incredible journey of Rajat Gupta. This man was born in Kolkata, orphaned as a teenager. I mean, he didn't just start from nothing. He started from way behind nothing. And yet somehow, by his mid-40s, he was the CEO of McKinsey, probably the most prestigious consulting firm on the planet. From there, he's working with the UN, he's doing philanthropy with Bill Gates, sitting on the boards of huge companies. By any measure you can think of, he was one of the most successful businessmen in the world. And with that success, of course, came an insane amount of wealth. By 2008, his net worth was sitting at around $100 million. Let's put that in perspective. A pretty standard 5% return on that much money would earn you almost $600 an hour. Every hour, 24/7. Whether you're working, eating, or sleeping. He literally never had to work another day in his life.
But here's the kicker. $100 million, it wasn't enough for him. See, he was on the board of Goldman Sachs, and he was surrounded by actual billionaires. And that $100 million circle? Suddenly, it felt kind of small. He wanted into their circle. He wanted more, and he wanted it bad.
So, what did he do? He cheated. Right in the middle of the 2008 financial meltdown, he's on a board call and learns that Warren Buffett is about to pump $5 billion into the bank to save it. This was top secret, priceless information. And look at this timeline. Just 16 seconds after he hears the news, he's off the board call and dialing up a hedge fund manager. That manager instantly buys a ton of stock and a few hours later makes a quick $1 million when the news becomes public.
And that one phone call, along with a few others, it cost him everything. For a couple $1 million in illegal cash, Rajat Gupta, the man who came from nothing and built an empire, went to prison. His career, his reputation, completely and utterly destroyed.
Okay, now let's talk about story number 2. We all know the name Bernie Madoff. We think of the biggest Ponzi scheme in history. But here's the part of the story that's absolutely tragic and often gets forgotten. He was already a brilliant, successful, and this is the important part, legitimate businessman. His market-making firm was a powerhouse on Wall Street, a real cash cow. We're talking tens of millions of dollars a year, all legal, all above board. He didn't need to cheat.
And this gets us back to this same haunting question for both of these guys. Why? Why would people who already have more money, more prestige, more freedom than they could ever use, why would they risk it all? They already had everything they needed. They had enough, and then they just torched it.
No, look, this isn't just a story about a couple of criminals. This way of thinking, this fool's gamble, it happens all the time, even with people who'd never break the law. It's about a mindset that's fundamentally broken. Take the hedge fund long-term capital management. This place was filled with actual geniuses, Nobel Prize winners, the smartest guys in the room. They were all multimillionaires already. But in their chase for even more money, they took such gigantic risks that they lost every single penny in 1998. And get this, 1998 was a fantastic year for the economy. The market was booming, and they still blew up.
Warren Buffett, of course, just nailed it when he talked about them. He said, to make money they didn't have and didn't need, they risked what they did have and did need. It's so simple, so powerful, and yet it's a piece of wisdom that so many smart people seem to forget.
So how do we make sure we don't fall into this same trap? Let's switch gears a bit. We've heard the horror stories. Now let's look at 4 practical rules that can help every single one of us figure out our own definition of enough.
First, and this one is maybe the most important, you have to get the goalposts to stop moving. You know, the hardest skill in finance isn't picking stocks. It's resisting that urge to want more every time you get more. The real danger is when your ambition starts growing faster than your satisfaction. You get a raise, so you want a bigger one. You hit a goal, so you set an even bigger one. You feel like you're always falling behind, which makes you take bigger and crazier risks just to try and catch up.
So what is it that keeps pushing those goalposts? Well, it's something we all do. It's social comparison. It's looking over at what the other guy has and measuring yourself against him. And let me tell you, that is a game you simply cannot win. The ceiling is so high, it might as well be in outer space.
Let me give you an example. A rookie baseball player makes $500,000 a year. To you and me, that's insanely rich. But in his own locker room, he might feel poor standing next to a superstar like Mike Trout, who's pulling in $36 million a year.
But see, that ladder just keeps going. Mike Trout, he might look at a top hedge fund manager who made $770 million in 1 year. And that manager, he's looking at Warren Buffett, who made 3.5 times billion that same year. And you know what? Even Buffett isn't at the top of that ladder. It's infinite. The only way to win the comparison game is to just refuse to play it.
Okay, rule number 3 is about how we think about the word enough. It doesn't mean you're being lazy or settling. Enough is a defense mechanism. It's about realizing that an endless appetite for more is eventually going to drive you right off a cliff. Think about it. The only way to know your absolute limit is to go past it. But in finance and in your life, going past that limit can mean total ruin. Enough is just the wisdom to say, okay, I'm good, before you get to that point of no return.
And that leads us to our last rule, and it might be the most profound one. There are some things in your life that are so important, you should never, ever put them on the table. It doesn't matter what the potential payoff is. They are not for sale, and they are not for gambling. So what are those things? What are the assets that are truly priceless? The kinds of things that, if you lose them, you can never, ever buy them back, no matter how much money you have.
After Rajat Gupta got out of prison, he gave an interview and said this. I mean, just read that. This might be the single worst lesson anyone could possibly take away from an experience like his. It's the sound of a man who just doesn't get it, trying to justify the absolute destruction he caused himself because he just couldn't stop reaching.
Let's be perfectly clear about something. Your reputation is invaluable. Your freedom, your independence, those are invaluable. Your family, your friends, being loved by people who actually care about you, and just being happy, these are the real treasures in life. And the best way to keep all of them safe is to know when you have enough and to stop taking dumb risks that could cost you everything.
So I'll leave you with this final thought. Most of us, if we're lucky, will get to a point in our lives where we have enough. Enough to cover our needs, maybe even a lot of our wants. The hard part isn't getting there. The real challenge, the thing that really defines a successful life, is recognizing that moment when you arrive and having the wisdom to stop the chase. Thanks for joining me.
Welcome to The Explainer. Today we're going to connect two things that seem like they are worlds apart: billion-year-old planetary freezes and the creation of modern financial fortunes. Now, I know that sounds like a stretch, but it's a link that reveals a powerful secret about how truly massive results are born from the smallest, and I mean smallest, of beginnings. So here's the big question for today. What on earth can something like an ice age teach us about building wealth? I know it's a strange one, isn't it? But the answer, well, the answer uncovers this universal principle that governs how absolutely staggering results can grow from the tiniest of seeds. So here's our game plan. We're going to start with this huge planetary mystery. Then we'll uncover the really subtle force behind it all. And then, and this is the cool part, we're going to apply that very same principle to one of the greatest financial stories ever told. I think you'll be pretty surprised how deeply connected these two things really are. It's really amazing when you think about it, how a lesson from one field can totally unlock a profound truth in a completely different one. And this connection between geology and finance, it's just a perfect example of that. Okay, so for the longest time, scientists were just completely baffled. They had all this clear evidence from all over the world. Giant boulders dropped in random places, huge rock beds scraped totally clean. And it all pointed to one thing. Our planet had been covered in ice. But not just once, at least 5 distinct, separate times. The amount of energy needed to do that is just staggering. So, naturally, their first theories looked for a cause that was just as massive. The early theories were, they were grand. They assumed that a massive effect must have a massive singular cause. So maybe huge mountain ranges rose up out of the earth and changed the climate. Or maybe massive volcanoes erupted all at once. But all these big ideas had a critical flaw. Sure, they might explain one ice age, but they couldn't explain the repeating cycle of freezing, thawing, and then freezing all over again. The real answer, which was figured out by a Serbian scientist named Milutin Milankovic, was way more subtle. It wasn't one big, violent event at all. Instead, It was the gentle, persistent, long-term gravitational pull from the sun and the moon that slightly, ever so slightly, changes Earth's orbit and its tilt over thousands and thousands of years. A tiny, almost imperceptible change with planet-freezing consequences. So the big question is, how does such a tiny little change actually trigger a full-blown ice age? Milinkovic himself, he originally thought it must be due to brutally cold winters. But the real mechanism, it's much more subtle and honestly far more powerful. That's it. That's the secret right there. The entire cycle, the freezing of a whole planet, it doesn't kick off with a savage winter. It begins when a summer is just a little too cool to melt all of the snow from the winter before. And that one little leftover patch of snow, that's what starts the chain reaction. See, that thin base makes it easier for more snow to stick around the next winter. Then that larger snowpack reflects more sunlight back into space, which actually cools the area down even more. And this local cooling leads to, well, you guessed it, even more snow sticking around the following summer. The process just feeds on itself. And in what is a geological blink of an eye, a small seasonal snowpack grows into a continent-sized ice sheet. I love this quote from glaciologist Gwen Schultz. She put it brilliantly. The key wasn't the initial amount of snow. The key was its persistence. It was the simple fact that a little bit of it lasted, and that provided a foundation for all the future growth. And this just perfectly illustrates the core idea of compounding. If a little bit of growth serves as the fuel for future growth, then a tiny starting base with a persistent advantage can lead to results that just seem to defy all logic. And so it is with money. There are literally over 2,000 books out there trying to explain Warren Buffett's incredible success. But the vast majority of them, they completely miss the simplest and, by far, the most important factor of all. We all know the number. It's just staggering. But the number itself isn't the lesson here. The real story, the real secret, is how that number came to be. Just look at that. Of his $84.5 billion fortune, $81.5 billion of it, that's practically all of it, was generated after he was in his mid-60s. So the crucial point here is this. He wasn't just a good investor, he was a good investor for an incredibly, unbelievably long time. Okay, so let's just run a little thought experiment. Buffett started investing when he was 10 years old. But what if he'd been a normal person, traveled a bit, found his passion, and only started investing seriously at age 30, and then retired at 60? Even if he got the exact same phenomenal annual returns, his net worth today wouldn't be $84.5 billion. It would be about $11.9 million. That's 99.9% less. His skill is investing, sure, but his secret is time. And to really see the power of time, look at Jim Simons from Renaissance Technologies. If you're measuring by pure annual returns, Simons is arguably the greatest investor of all time. He compounded money at an unheard of 66% a year. That's 3 times better than Buffett. And yet, Buffett is over 3 times richer. Why? Well, the reason is that Simons didn't really find his investing stride until he was 50. That gave him less than half as much time for his incredible skill to work its magic. So if time is this powerful, why do we so often overlook it? Well, it's because our brains, they're naturally wired for linear thinking, not for the wild, exponential curves of compounding. And this creates a huge blind spot in our intuition. Our minds handle linear thinking just fine, right? If I ask you to add 8 to itself 9 times, you can probably do that in your head. It's 72. But if I ask you to multiply 8 by itself 9 times, the result is over 134 million. The scale just becomes so large so quickly that our intuition completely breaks down. The history of computer hard drives is a perfect real-world example of this. For the first 40 years, we went from a few megabytes to a few hundred, slow and steady. Then, in the next 30, things just went nuts. We gained nearly 100 million megabytes of storage capacity. It's so counterintuitive that as recently as 2004, Bill Gates was questioning why anyone would ever need a whole gigabyte of storage. You see, even the experts can't wrap their heads around it. And the real danger of this blind spot is that we end up focusing all our energy on the wrong things. We chase the highest possible returns this year, this quarter, this month, instead of focusing on what really truly matters for building long-term results.
So, if we took this profound lesson from the Ice Ages and from Warren Buffett and we just boiled it all down to its absolute core, what would be this single most important piece of advice? What would the title of the best investing book in the world be?
That's it. It's about letting the process work its magic. Good investing, it isn't really about earning the highest possible returns because those tend to be these spectacular one-off hits that you just can't repeat. No, it's about earning pretty good returns that you can stick with, that can be repeated for the longest period of time possible. This is when compounding truly runs wild and creates those outcomes that just defy logic. It's the small, persistent advantage, like that cool summer snow that just refuses to melt, that ultimately builds the continental ice sheet.
And that's really the big idea from this whole explainer. Whether we're talking about ice or investments, maybe the real superpower isn't strength, but endurance. Thanks for watching.
You know, we talk a lot about how to make money, how to build a fortune, but we almost never talk about how to keep it. And as we're about to see, getting wealthy and staying wealthy, well, they're two completely different games, played by two completely different sets of rules. Okay, let's get into this.
This quote just nails it, doesn't it? Building a fortune often means taking big risks, being wildly optimistic, and really putting yourself out there. But protecting it? That's a totally different skill set. It relies on a mindset we don't really celebrate all that much, a healthy, productive dose of fear.
And this right here, this is the big idea for our whole explainer. It sounds so simple, but it's a lesson that some of the most brilliant financial minds in history had to learn the absolute hard way. And honestly, there's no better way to get this than by looking back at a single pivotal moment in time.
So, we're going to jump in a time machine. We're going back to the Roaring '20s and the historic crash that brought it all to a screeching halt. This is a story about two men whose lives were defined and ultimately shattered by their relationship with wealth.
Okay, so in one corner, you've got Jesse Livermore. The guy was a trading prodigy, a total legend on Wall Street. In the other corner, Abraham Jermansky, a massively successful real estate tycoon, just riding that crazy wave of the 1920s boom. Both guys were at the absolute top of their game, and both were betting big on the stock market, just from opposite sides of the table. And then it happened. October 1929. In just a few days, the whole floor just fell out from under the economy. Black Monday, Black Tuesday, Black Thursday. It was a relentless, cascading disaster. Fortunes that took years, even a decade to build, were just gone, erased in a matter of hours. The financial world was completely turned upside down.
But for Jesse Livermore, this catastrophe was the single greatest moment of his life. See, he had bet against the market. He shorted stocks with this incredible, almost psychic timing. In one day, he personally made the equivalent of over $3 billion. I mean, just try to wrap your head around that number. It's almost impossible.
You have to picture the scene. Livermore gets home, and his family is in tears. They are absolutely sure they are destitute, just like everybody else they know. And he has to tell them, no, we're not ruined. We are fabulously, unbelievably rich. This quote from his wife, Dorothy, man, it just captures that dizzying whiplash from total ruin to unimaginable riches.
But for every winner in that crash, there were countless losers. And this is the last anyone ever heard of Abraham Jermansky. He'd bet on the boom, and the bus wiped him out completely. This haunting image, reported in the New York Times, is all that's left of his story. A man just methodically destroying the symbol of his own ruin before he just vanished.
Okay, but right here, this is where the real lesson actually begins. Because if you think this is just a simple story of a winner and a loser, you'd be dead wrong. The fates of these two men are way more connected than you might think.
So after that monumental win, Livermore started to feel, well, invincible. He started making bigger and bigger bets, just doubling down again and again. And the very skills that made him a genius at getting rich, his boldness, his aggressive confidence, his willingness to risk it all, those became the very things that destroyed him. Within 4 years, he lost everything. Just like Jermansky, he was ruined. And tragically, his story also ends in suicide.
And this story just perfectly illustrates our main point. Both of these men were absolute masters at getting wealthy. And they were both terrible at staying wealthy. So what is this hidden skill? It's the skill of survival. That's the one thing that separates a quick flash in the pan from enduring generational wealth.
Let's break this down because it's so important. To make money, you almost have to be an optimist. You've got to take some risks. But to keep money, you have to be a little bit of a pessimist. You need the humility to know that your past success doesn't guarantee a thing about the future. You need to be paranoid enough to see trouble coming before it hits. And you absolutely have to respect the role that luck played in getting you where you are.
And look, this isn't just some dusty lesson from the history books. This is Michael Moritz, a modern-day billionaire venture capitalist. His firm, Sequoia Capital, has basically dominated Silicon Valley for decades. And his secret? Constant fear. He calls it a productive paranoia, that tomorrow could be the day it all goes wrong. They focus on survival, not just winning.
And this pattern just shows up again and again. Take this story. Everybody knows Warren Buffett and Charlie Munger, right? But there used to be a third partner, a guy named Rick Guerin. Buffett himself said Guerin was just as smart as they were. The only difference? Guerin was in a hurry. He used a ton of leverage, margin loans, to try and get rich faster. When a brutal downturn hit in the 70s, he got wiped out. He was forced to sell his shares to Buffett. Guerin was brilliant at getting wealthy, but he never mastered staying wealthy.
So, the billion-dollar question is, how do we actually apply this stuff? How do we cultivate this survival mindset in our own lives? Well, it really comes down to 3 key rules.
All right, here's the framework. First, your #1 goal should be to become financially unbreakable. Second, you have to plan for your plan to fail. And third, you need to develop what's called a barbelled personality. Let's walk through each one.
This is all about durability. Look, longevity is the secret sauce in compounding. The goal is not to get the highest possible return in 1 year. The goal is to get pretty good returns that you can keep getting for the longest possible time without ever being forced to quit the game. Being unbreakable means you survive the downturns that are guaranteed to happen, and you stay invested long enough for compounding to really work its magic.
This idea of being unbreakable leads right into our second rule, building a margin of safety. Now, this isn't about being overly conservative. It's about deliberately building a buffer for when things go wrong. It's room for error in your plan so that when life throws you that inevitable curveball, and trust me, it will, you don't get knocked out. This could be extra cash, a flexible budget, or just a timeline that doesn't demand perfection.
And if you're not sure you need that margin of safety, just look at the last couple of decades. How many financial plans from the year 2000 predicted any of this? 9/11, the housing crisis, a global pandemic. The world is fundamentally unpredictable. A good plan doesn't try to predict the future. A good plan accepts that the future is unpredictable and prepares for it. And that brings us to our final rule, which might be the trickiest one. It's about holding 2 beliefs that seem to completely contradict each other at the exact same time. You need to be optimistic about the long-term future while also being paranoid about all the short-term threats that can stop you from ever getting there.
This slide just shows it perfectly. It's that barbelled reality. Over the long haul, things get astoundingly better, a 20-fold increase in the standard of living. That's the optimism. But that whole journey was filled with constant, gut-wrenching peril, recessions, wars, crashes, crises. That's the paranoia. You need both. You need that short-term paranoia so you can survive long enough to enjoy the fruits of that long-term optimism.
And that brings us full circle, right back to the man who kicked off our story, Jesse Livermore, and the devastatingly expensive lesson he learned way too late.
These are Livermore's own words, looking back on his own downfall. He called it the swelled head, that toxic, poisonous belief that he was invincible. His spectacular success destroyed the humility and paranoia that he needed to stay wealthy. He paid the ultimate price for that lesson. It is a powerful, powerful warning for all of us.
So I'll just leave you with this one question to think about. As you plan your career, your investments, your entire life, which game are you actually playing? Are you only focused on that thrilling climb up the mountain, or are you also preparing for the treacherous journey back down? Because in the end, survival is the only skill that really matters.
Today, we're going to pull back the curtain on this really powerful and kind of weird force that basically runs the world. It's a concept that explains why most things we try seem to fail, but a tiny, tiny few succeed on a scale that's almost impossible to imagine. And you know what? Understanding this one idea might just be the secret to winning at, well, pretty much everything.
You know, you probably didn't expect to get financial wisdom from Brad Pitt, but honestly, it's perfect. He gets it.
Success isn't about hitting a home run every single time. It's about staying in the game long enough, taking enough swings because you know the entire outcome is going to be decided by a few monster hits. This really sets the stage for everything we're about to get into.
So to really get our heads around this, I want to tell you a story about a guy named Heinz Berggruen. He had to flee Nazi Germany back in 1936. Shows up in America with basically nothing. And by all accounts, there was nothing that special about him. And yet, this guy would go on to become one of the most successful art dealers in history.
And that's the big question, right? It's the puzzle. How does that happen? In the year 2000, Berggruen sold a chunk of his private collection. We're talking Picassos, Klees, Matisses, to the German government for a price so low people basically called it a gift. The real value? Over $1 billion. So how did one guy, in a field as wild and subjective as art, get it so unbelievably right? Was he a genius? Incredibly lucky? Or was something else going on?
Well, the secret, it turns out it was almost shockingly simple. Berggruen wasn't some kind of art whisperer who could spot a masterpiece from a mile away. No, he just bought tons of art, everything he could get his hands on. He was basically running his gallery like an index fund. He knew that 99% of the stuff he bought would probably be duds, worth next to nothing. But that didn't matter, because the other 1%, that 1% would be the Picassos. And those few pieces would pay for all the failures, 1,000 times over.
All right, so here's how we're going to break this all down. First, we'll dig a little deeper into the art dealer's secret. Then, we're going to talk about the raw power of these so-called tail events. From there, we'll uncover the market's hidden engine, learn about winning by not panicking, and we'll wrap it all up with the profound wisdom of failure.
So this is really our starting point. This idea that you can be wrong, and wrong, and wrong again, and then land one success so big that all those other failures just become irrelevant trivia. Berggren's story isn't some weird fluke. It's the perfect example of a fundamental rule of the universe.
And that rule is all about something called long tails. Just picture a chart of all the possible results for anything, right? Most of the outcomes are going to be clumped right there in the middle. The average stuff, the meh results. But way, way out on the edges of the chart, those are the tails. These are the extreme events, the ones that almost never happen. But when they do, their impact is absolutely colossal. In business, in investing, you name it, pretty much everything that really matters happens way out there in the long tail.
Okay, now let's see this exact same idea play out in a totally different world. This isn't just about art dealers. The same logic is responsible for building one of the most massive entertainment companies on the entire planet. You know, Walt Disney's early days were just a brutal string of failures. His first studio went bankrupt. Through the mid-1930s, his new studio made over 400 cartoons. And yeah, people liked them, but they cost a fortune to make and almost all of them lost money. The company was constantly on the verge of collapse. And then came Snow White. In just 6 months, that one movie made more money than every other project the studio had ever done, combined. That single 83-minute film was a massive tail event. It paid off every single debt, funded a brand new studio, and basically guaranteed the Disney legacy forever.
And this is where it really clicks. This isn't just a fun story about Mickey Mouse. It's a fundamental law. I mean, think about it. Any company, any product, any person that's a household name, their success is almost guaranteed to be a 1 in a million long-tail outcome. We get so fixated on the giant successes that we totally forget how incredibly rare and unlikely they really are.
Now, you'd probably expect this kind of thing in really risky fields, right? Like venture capital. It's a world of home runs or strikeouts. We all know that. But the truly shocking part is where else this engine is hiding, in places we think of as much, much safer.
And yeah, the data from venture capital is exactly what you'd think. A massive study of over 21,000 investments found that 65% of them flat out lost money. But then you look at the other end of the spectrum. Just half of 1%, that's 1 in every 200 deals, delivered a 50x return or more. And that tiny little slice, that's not just part of the profits, it is the profits, the whole thing.
So you see those numbers and you think, okay, yep, that's exactly why I stick with boring old blue chip stocks. I want safety, not lottery tickets. But what if I told you that the regular old stock market is running on the exact same brutal logic?
And here it is. This is the big shocker. Let's take the Russell 3000 index, a huge basket of established companies. Since 1980, 40% of them have been total disasters. I mean, they lost the vast majority of their value and just never came back. And at the same time, pretty much all of the index's gains came from just 7% of the companies. It's the exact same tail-driven dynamic as high-risk venture capital. It's just been hiding in plain sight this whole time.
And yet, and this is what you really have to let sink in, even though 4 out of every 10 companies in it were complete duds, the Russell 3000 index as a whole went up more than 73-fold in that time. So what does that tell you? It tells you the success of the index had nothing to do with avoiding losers. Its success came because the handful of massive winners were so unbelievably huge, they made all the losses from the hundreds and hundreds of failures completely irrelevant.
Okay, so this brings us to the really practical part of all this. Because understanding tails isn't just about analyzing numbers on a chart. It's about managing yourself. It turns out our own actions, especially how we act when we're scared, can be the biggest tail event of them all.
I absolutely love this quote from Napoleon. He wasn't talking about some brilliant 5D chess move on the battlefield. For him, a genius was just the guy who could keep his head and do the normal, average thing while everyone else was running around screaming. And you know what? In investing, that is literally the entire game. Let's just make this crystal clear with a little story. Imagine 3 investors, Sue, Jim, and Tom. Sue's plan is dead simple. She puts $1 into the stock market every month like clockwork, no matter what, rain or shine. Jim and Tom, they think they're smarter than that. They try to time the market. When they hear the word recession, they sell everything and wait for things to feel safe again before jumping back in.
And look at the results. It's not even a contest. Sue, the one who just did the average thing and stayed calm, she ends up with over $435,000. Jim and Tom, who tried to be clever and got spooked by recessions, end up with way, way less. Now, recessions only made up about 1/5 of this whole period, but how they behaved during those short bursts of panic basically defined their entire financial future.
So if we accept this, that tails drive everything, it just completely flips our whole idea of failure on its head. See, failure isn't a sign you're doing something wrong. In a world run by tails, having a lot of failures isn't just okay, it's actually a requirement for success. Think about a comedian like Chris Rock. You watch his Netflix special, and it's perfect. Every single joke is a killer. But that polished special, that's the tail event. What you don't see is the process. To get there, he does maybe 40 or 50 shows in tiny little clubs. He's up there testing hundreds of jokes, fumbling with his notes, and just watching most of his new stuff completely bomb. He's literally looking for failure so he can find that tiny handful of jokes that are absolute gold. The masterpiece we get to see is just what's left over after 95% of the crap has been thrown away.
In this way of thinking, it's everywhere among the investing legends. Warren Buffett says most of his massive fortune came from just 10 of the 500 stocks he's owned. His partner, Charlie Munger, is even blunter. He says Berkshire Hathaway's record is just pretty average if you take out their handful of best investments. Soros, Lynch, they all say the same thing. You don't have to be right all the time. In fact, you're going to be wrong a lot. You just have to make sure your wins are huge when they finally come.
And this quote from Jeff Bezos, right after the Amazon Fire Phone was this giant public flop, this is the modern CEO version of that whole philosophy. He's not apologizing. He's almost bragging about how big they're willing to fail. He gets it. To find the next Amazon Web Services, a tail success that makes billions and billions, you have to be willing to stomach some epic flameouts along the way. Bigger swings mean bigger misses, but they're the only way you'll ever hit a bigger home run.
And so let's just end with this. Let's zoom way, way out. Out of 100 billion planets in our galaxy alone, as far as we know, this is the only one with intelligent life. The chain of events, cosmic, biological, historical, that had to happen against all odds for you to be here right now, it's the outcome of the longest, most improbable tail event you can possibly imagine. The chances were basically zero. And yet, here you are. So the only question left is, knowing that, what are you going to do with it? Welcome to The Explainer. So let's talk about money. We spend pretty much our entire lives chasing it, saving it, thinking about it. But what is it really for? I mean, what are we actually trying to buy with all that effort? It's a fundamental question, so let's really dive into it.
You know, this quote, it just gets right to the heart of the matter. We all think that being wealthier will make us happier. And sure, it can, but happiness is a complicated thing. If you try to find the one common denominator, that universal fuel for joy, it really boils down to this. People want to control their own lives. The ability to do what you want, when you want, with who you want, for as long as you want, that is just priceless. It's the highest dividend that money can possibly pay.
I want to tell you a quick story from my own life that really drives this point home. It was a time when I thought I'd absolutely won the career lottery. I was young, I was ambitious, and I was so sure I knew what success looked like. But it ended up being one of the most miserable experiences you could possibly imagine.
Throughout college, this was it. This was my single-minded goal. And you know, if I'm being completely honest with you, there was really only one reason why. They made a ton of money. That was it. That was the entire motivation. I was absolutely certain that a huge paycheck would make me happy. No question about it.
And look, on the surface, the job had everything I thought I wanted. I ended up scoring a summer internship at an investment bank out in Los Angeles, and I really felt like I was on top of the world. The work was super stimulating, it paid incredibly well, and yeah, it definitely made me feel important. It ticked all the boxes for what I thought success was supposed to be.
But the reality? Oh man, it was a brutal trade-off. There was this common saying in the office that everybody knew. If you don't come to work on Saturday, don't bother coming back on Sunday. Every single waking second of my life was a slave to my boss's demands. I only lasted a month of the 4-month internship. The price for all that pay and prestige was a total, complete loss of control over my own life.
And here's the part that really got me, the part that totally surprised me. The hardest part wasn't the work itself. I actually loved the work. I wanted to work hard. But having zero autonomy, absolutely no control over my own schedule, it just poisoned the entire experience. It was such a powerful lesson. Even passion can't survive when you have a total lack of freedom.
You know, there's actually a psychological term for this feeling, and it's called reactance. It's that deep-seated, gut-level pushback we all feel when someone or something tries to take away our freedom of choice. It's a really powerful motivator, and it explains exactly why we resist being controlled.
The marketing professor Jonah Berger explains it so well here. We all have this fundamental human need to be in the driver's seat of our own lives. The moment we feel like a choice is being made for us, we feel disempowered. We might even say no to something we would have otherwise wanted just to prove that we're still the one in control.
Okay, so if a high-paying, prestigious job doesn't automatically equal happiness, then what does? And this isn't just some philosophical question. A psychologist by the name of Angus Campbell actually dedicated his entire career to finding a scientific answer.
Campbell's research, it was really groundbreaking. He found that you couldn't reliably group happy people by their income or their geography or even their education. The most powerful common denominator was actually incredibly simple: having a strong sense of control over your own life. That, he found, is the most dependable predictor of happiness. Period.
So here's the crucial point. The greatest intrinsic value of money isn't its ability to buy you fancy cars or bigger houses. No, its real value is its ability to give you control over your time. It's the ability to purchase your own independence, your own autonomy, little by little.
And in the real world, this builds up kind of like climbing a ladder. A little bit of wealth means you can take a sick day without that financial panic, right? A bit more means you can wait for a good job after a layoff instead of just grabbing the first thing that comes along. Each rung up that ladder gives you more options, more freedom, and a whole lot less fear, all the way up to the top, being able to retire when you want to, not just when you have to.
All right, so let's zoom out a little bit from the individual to the whole society. If having control over our time is the real key to happiness, what's happened in a country like the United States as we've all gotten richer and richer over the decades?
I mean, the United States is the richest nation in the history of the world. And these numbers, they're pretty striking. The median family income, when you adjust it for inflation, has more than doubled since the 1950s. And the size of our homes has absolutely exploded. By pretty much every material metric you can think of, we are just vastly wealthier than we were a couple of generations ago.
But here's the paradox. There's very little evidence that we're any happier. In fact, a 2019 Gallup poll found that Americans reported feeling a lot of stress and a lot of worry at rates that were significantly higher than the global average. We're richer, for sure, but we're also way more stressed out.
So what on earth explains this disconnect? Well, we made a trade. We used all that increased wealth to buy bigger and better stuff, which is great, you know? But at the same time, we've given up more and more control over our time. And the real culprit here is a fundamental shift in the very nature of our work.
The data here tells a really clear story. If you go back to 1870, the vast majority of jobs, we're talking over 80%, are in farming or manufacturing. These were tangible jobs. You labored with your hands. Today, that's completely flipped on its head. The vast majority of jobs are now in professional or service roles where you work with your brain.
And this quote from Derek Thompson, it just absolutely nails it. The main tool for a knowledge worker is your own head. and you can never leave it at the office. You might be thinking about a project on your commute, or while you're making dinner, or when you wake up in a panic at 3 in the morning. Work isn't a place you go anymore. It's a thing you do, potentially 24/7.
So how do we fix this? How do we start to reclaim that control that's so important? Well, the first step is just to acknowledge what actually matters. And for this, we can learn a tremendous amount from the people who have the longest perspective on life.
A gerontologist named Carl Pillemer interviewed 1,000 elderly Americans for a book, and he asked them for the most important lessons they'd learned from their lives. And what's so fascinating is what they didn't say. Not a single person said you should work as hard as you can just to buy more stuff. Not one said you should try to keep up with the Joneses.
Instead, what they valued were things like deep, quality friendships, being part of something bigger than themselves, and spending quality, unstructured time with their children. As Pillemer writes, your kids don't want your money anywhere near as much as they want you. Specifically, they want you with them. That's powerful stuff.
This whole idea is perfectly captured by the entrepreneur Derek Sivers. He tells this great story about a friend asking him when he got rich, and the friend just assumed it was when he sold his company for millions of dollars. But Sivers said no, that wasn't it. He said he became rich when he was 22, back when he'd saved up just $12,000. Why? Because that was enough money for him to quit his minimum wage job and become a full-time musician. That was the moment he bought his freedom.
And that right there is the ultimate takeaway. The ability to do what you want, when you want, with who you want, for as long as you want, that is the real currency of freedom. That is the ultimate goal. That is, without a doubt, the highest dividend that money can possibly pay.
And this leaves all of us with a pretty profound choice, doesn't it? As we build our careers and manage our finances, we face this question every single day. You can use your wealth to get bigger and better stuff, or you can use it to buy more control, more options, and more time. So, which dividend will you choose? What do you truly want your wealth to do for you?
You ever have that feeling? You're working hard, you're chasing success, and you've got this one thing in your mind. Maybe it's a car, maybe it's a big house, and you think, once I get that, everyone will know I've made it. You think it'll finally get you the respect you deserve. Well, we're about to dive into this really fascinating psychological quirk that says that whole way of thinking might be, well, a total trap. It's called the man-in-the-car paradox, and honestly, understanding it might just change what you're chasing.
Just let that sink in for a second. Be honest with yourself. A shiny, brand new Ferrari pulls up next to you at a stoplight. What's the first thing you think? Are you really thinking about the character of the person behind the wheel? Or is your mind somewhere else completely? This one simple observation, right here, is the key that unlocks this whole powerful paradox about wealth, desire, and what we're actually looking for when we crave admiration.
All right, so here's the game plan for today. We're going to start with a really cool story about a valet, which you'll see leads to a pretty ironic realization. Then we'll get into what the paradox actually is, how it's about way more than just cars, and then, this is the important part, we'll look at a much better way to earn what we're all really after.
So our story kicks off, appropriately enough, at a super high-end hotel, and we're seeing it all through the eyes of a young valet. You know, this is the kind of place where the dream of being rich feels like something you can almost touch. I mean, just picture it. Your job, every single day, is to slide into the driver's seat of the most amazing cars in the world. For this guy, it wasn't just a gig, it was like a masterclass in luxury. And of course, it sparked a dream. One day, he was going to own one of these beautiful machines himself.
But here's what's really fascinating. It's the why. Why did he want the car? He was convinced that these cars sent out this powerful, almost primal signal to anyone who saw them. A signal that just screams, I'm a success, I'm smart, I'm somebody you should pay attention to and, admire. It's a message a lot of us, whether we admit it or not, are kind of hoping our own stuff will send for us.
But here's where the story takes a turn. As he spent more and more time surrounded by all this insane wealth, this strange and kind of ironic thought started to creep in. He realized the signal he thought the cars were sending, well, it wasn't being received the way he thought it was. Not at all.
And boom, there it is. That's the whole thing in a nutshell. When one of those incredible cars pulled up, his eyes, his admiration, all of his focus, it was on the car. The person in the driver's seat, they were basically invisible, just an accessory. He was admiring the object, not the owner.
So the little voice in his head wasn't saying, wow, that driver must be an amazing person. Nope. It was saying this. It was all about him. He was using someone else's car as a mental billboard to project his own fantasy of being admired. He wasn't giving the driver respect,
He was using their wealth as a yardstick for his own desires. And this just begs the question, right? Did the drivers, the people who probably dropped a fortune on these cars to feel seen and admired, did they have any clue that the very people they wanted to impress weren't even seeing them? That the admiration they were getting was for the machine, and they, the owner, were getting totally bypassed in the transaction?
And this whole phenomenon brings us to its official name. It's such a subtle but really profound psychological trap, and honestly, it's one that a lot of us can fall right into when we tie up our self-worth in the things we own.
Okay, let's break that down because it's so important. It's a two-part problem. On one side, you've got the person buying the fancy thing, and their goal is to get admiration. But on the other side, you've got everyone else looking at it, and instead of admiring the owner, they just think, man, I want that thing so that I can be admired. See what happens? The admiration never actually makes it to the owner. It gets short-circuited.
This little flowchart here shows exactly how that broken logic plays out. I mean, it starts with a totally human desire, right? We want respect, so we think an expensive thing is the right tool for the job. But, and here's the key, when other people see it, they don't see us. They just see the tool, and they immediately use it as a benchmark, picturing themselves with it. And just like that, our original goal gets completely ignored. It's a perfect breakdown of a really common mistake.
Now, it's really easy to just pick on supercars, but let's be real. This paradox is not just about expensive cars, not by a long shot. Its logic applies to pretty much every status symbol out there. I mean, think about it. When you drive past some massive mansion, what are you thinking about? The architecture, the landscaping, or are you deeply contemplating the specific character traits of the family that lives inside?
Yeah, the answer's pretty obvious, isn't it? We almost never think about the people. We're imagining ourselves living in that house. We use it as a benchmark for what our own life could be. The owner, again, is pretty much irrelevant to the daydream that they paid for.
All right, so what about more personal stuff? You know, a fancy watch, designer clothes, expensive jewelry? I mean, surely those are more connected to the person wearing them, right?
Nope. Same logic holds up. We might take a half second to admire the watch, but our very next thought is almost always a projection. Man, that would look good on my wrist, or I wish I could afford that. We're not thinking about the deep inner character of the person wearing it. We're just using their stuff as another benchmark for what we want.
And look, this is a really critical point. This is not some argument against making money or enjoying nice things. Not at all. It's about being brutally honest about what money can and cannot buy. And if your true goal is real, genuine respect and admiration from people, well, using money to buy fancy things is just a really inefficient and often totally ineffective way to get it.
So, if horsepower and big houses don't actually work, what does? This brings us to the real stuff, the actual currency of respect, the things you absolutely cannot buy, but have to earn.
Let's just circle back to the original goal here. It was never really about the car. It was never about the house. Those were just the tools we thought would work. The end goal, the real desire, is to be respected and admired by the people around us. The paradox just shows us that throwing money at stuff is a very roundabout and usually failed way to get there.
And this slide right here, it lays out the solution so perfectly. It's the imagined path versus the actual path. We chase horsepower thinking it's a signal of power, but what people really respect is humility. We buy fancy watches hoping people will admire us, but simple, genuine kindness is way more magnetic. We build these huge houses to show how important we are, but it's empathy, the ability to actually connect with another person, that makes people value you.
And that really is the ultimate takeaway, isn't it? These qualities, these are the true currency of admiration. Unlike a car, you can't buy them. Unlike a watch, you can't fake them for very long. They are qualities that people see in you, not on you. And they can't be bypassed. They can't be used as a benchmark for someone else's desire. They're just authentically yours.
So I'll just leave you with this question to chew on. As you think about your own goals, your own ambitions, just take a second to look at the tools you're using to get there. Are you investing in more horsepower, or are you investing in more humility? Because understanding the man-in-the-car paradox, it really might change the entire way you go about getting what you truly want.
You know, money is just full of these strange little ironies. But I think the biggest one, the one that really messes with our heads, is this. Real wealth, the kind of wealth that gives you freedom, is almost always completely invisible. It's the exact opposite of everything society screams at us to admire.
So, just for a second, what do you picture? When you think of a wealthy person, what pops into your head? Is it the Ferrari, the sprawling mansion, the Instagram feed that looks like an ad for a private jet company? Well, I'm here to tell you that what you're picturing is a mirage, because those things, they're not signs of wealth, they're just receipts for a ton of spending.
All right, here's our game plan for this explainer. We're going to start by peeling back the curtain on this illusion of richness. Then we'll draw a super important line in the sand between being rich and being wealthy. From there, we'll tackle something called the millionaire paradox, get into why building real wealth is so dang hard, and then we'll wrap up by hopefully giving you a totally new way to look at your own finances.
To kick things off, I want to take you back to when I was in my mid-20s. I had a job as a valet at a pretty fancy hotel in Los Angeles. Now, if you know anything about LA, you know it's a city where looking the part is basically a full-time job. What you drive, what you wear, it often feels like it matters a lot more than who you actually are.
So there was this one guy, a tech entrepreneur we'll just call Roger. He was young, looked sharp, and he drove this absolutely gorgeous Porsche. And I'm telling you, every time he pulled up, you could just feel this wave of admiration wash over everyone. That car did all the talking for him. The funny thing is, we had no idea what Roger actually did. And honestly, we didn't really care. The Porsche told us everything we thought we needed to know. This guy had made it. He was rich. And we all do this, right? It's just human nature, because it's the only information we have. You can't see someone's bank statement, but you can definitely see their car. So we use these visible clues, the cars, the watches, the fancy vacations, as a stand-in for financial success.
But then one afternoon, Roger pulls up and he's in this beat-up old Honda. And we all kind of looked at each other, totally confused. The next week, same thing. And the week after that. The gleaming symbol of his success had just vanished.
So finally, I caught him on a quiet day and just asked him, "Hey man, what happened to the Porsche?" And he just said it, totally casual, not a hint of shame. "Oh, it got repossessed. I defaulted on the loan." And just like that, every single assumption we'd built up about this guy was completely wrong. That's when I learned that Los Angeles is just full of Rogers, people who look incredibly rich but are really just one missed payment away from the whole thing falling apart.
Roger's story just gets right to the heart of it all. His Porsche wasn't a sign of wealth. The real story was the money he didn't have to actually afford it. Wealth is the car you don't buy. It's the diamond you don't wear. It's the first-class upgrade you say no thank you to. It's the financial assets, the stocks, the bonds, that are just sitting there, growing, giving you options. By its very nature, true wealth has to be hidden.
So, this core idea brings us to a distinction that, I promise you, once you really get it, it will change the way you see money forever. It's the difference between being rich and being wealthy. And this isn't just about playing with words. This confusion is the root cause of countless bad financial decisions.
Okay, so check this out. On one side, you have rich. Think of being rich as a measure of your current income. It's a flow of money. Someone making $1 million a year is definitely rich. And that high income makes it possible to spend a whole lot, which is why being rich is usually super visible. But being wealthy, that's a whole different animal. Wealth is hidden. It's the income that you didn't spend. It's the accumulated pile of assets that are out there working for you even when you're sleeping. And at the end of the day, wealth isn't about owning more stuff. It's about owning your time. It's the freedom to walk away from a job you can't stand. It's the flexibility to handle a big medical bill without panicking. It's the power to decide when you're done working for good. That is the real currency of wealth, having control over your own life.
Okay, so if being wealthy is so great, then why do we get this so wrong all the time? Well, it comes down to this fundamental psychological trap, a kind of mental blind spot we can call the millionaire paradox.
I absolutely love this quote. The singer Rihanna almost went bankrupt from overspending, so she sued her financial advisor. And this was his defense. It sounds almost laughably obvious, doesn't it? But here's the crazy part. Most of us are wired to believe the exact opposite. And here is the paradox in a nutshell. When people say, "I want to be a millionaire," what they're actually picturing is spending $1 million. They're dreaming of the cars, the yachts, the whole lavish lifestyle. But that is the literal opposite of being a millionaire. To have $1 million, you have to, well, not spend it. The investor Bill Mann just hits the nail on the head here. Spending a bunch of money gives you this immediate, powerful shot of feeling rich. It's a dopamine hit for sure. But that feeling is fleeting. The way to actually be rich, to build something that lasts, is way less exciting. It's spending less than you make. But we can take that great advice even one step further.
It's not just about not going into debt. The only way to build real, lasting wealth is to not spend the money that you actually do have. That gap between what you earn and what you spend, that's the seed from which all wealth grows. It is the definition of wealth.
Now, this all sounds simple enough on paper, but we all know it's incredibly difficult in real life. Building wealth is psychologically tough for a very specific reason, and it actually has a lot in common with another struggle many of us face every day.
Think of it like diet and exercise. Let's say you have a fantastic workout. That's like earning a high income. You put in the effort, you feel great, you feel like you've earned a reward. So you go and treat yourself to a burger and fries that have double the calories you just burned. Then that result? You've actually gone backward. Finance works the exact same way. A huge salary is totally pointless if you spend it all. And then some. Wealth isn't what you earn, it's what you keep.
And here's the deepest challenge of all. As humans, we learn by watching other people. We see, we copy. The problem is, the rich role models are everywhere. They're on TV, they're all over your social media feed, showing off. But the truly wealthy role models, they're practically invisible. Their success is quiet, which makes it almost impossible to learn from them.
Let me give you the absolute perfect example of this. This man is Ronald Read. For his entire life, he worked 2 jobs. He was a janitor in Vermont and a gas station attendant. He lived in a simple house that he bought for $12,000 and he drove a used car. To everyone who knew him, he was just a regular, hardworking, humble guy.
But when Ronald Read passed away at the age of 92, the world was absolutely stunned. It turned out he had left a fortune of, get this, $8 million to his local library and hospital. $8 million. How? He just patiently, quietly, and secretly built this incredible wealth by living a simple life and investing every spare dollar he had in blue-chip stocks, letting it compound for decades. He was the perfect example of an invisible millionaire, a true role model that no one could learn from because no one even knew he existed.
When you put Roger, the Porsche driver, next to Ronald, the janitor, the contrast couldn't be more shocking, could it? Their stories teach us this incredibly powerful lesson. We have to completely change the way we think about money and success. We need to put on a new financial lens.
So, let's lock in the big ideas here. First, and this is the most important one, remember that true wealth is invisible. It's the money that's not spent. Second, burn the difference between rich and wealthy into your brain. Rich is income, it's visible, and it can be temporary. Wealthy is assets, it's hidden, and it's what lasts. Third, just accept that you have absolutely no idea how well off someone is based on what they're wearing or driving. The world is full of modest-looking people like Ronald Read who are secretly wealthy. So stop judging. And finally, the whole point of this, the real goal of building wealth isn't to buy more things. The goal is to buy your freedom. That's the ultimate prize, control over your own time.
And all this leaves us with a really fascinating, almost philosophical question to chew on. If wealth is defined as the money you don't spend, then what's the point of having it in the first place? What good is it?
All right, let's talk about something that I think is the most important yet most misunderstood part of building a solid financial life: saving. We're going to dig into why your ability to just put money aside is the single most powerful tool you have. Not just for getting rich, but for actually designing the life you want to live. And yeah, that's what I'm here to do. I want to convince you. My whole goal with this explainer is to get you to see saving in a totally different way than you probably do right now. And don't worry, this isn't going to be some long, complicated lecture with a bunch of spreadsheets. The main idea here is actually incredibly simple, but I promise you, it has the power to completely change your financial future. Let's just cut through all the noise. Okay, so let's get right into it. The savings rate secret. Now, you might be thinking, saving is important, duh. Why does anyone need to be convinced of that? Well, here's what I've seen. Once people start making a decent living, they usually fall into one of 3 camps. You've got the people who are just natural savers. And hey, if that's you, that's awesome. But this is really for the other 2 groups. The people who feel like, I just can't get ahead, I can't save. And maybe even more important, the people who make good money but don't really think they need to save. So here it is. This is the secret. We're all taught to believe that building wealth is about getting that huge salary or picking that one stock that goes to the moon. But the truth? Real, lasting wealth has almost nothing to do with how much you earn or your investment returns. It has everything to do with your savings rate, how much you keep. That's it. That's the whole game. Now, to really hammer this point home, I want to tell you a quick story. It sounds like it has nothing to do with money, but trust me, it's the perfect analogy. We have to go back to the 1970s and the big energy crisis. So back in the 70s, everybody was panicking. The logic was pretty simple. The economy is growing, it runs on oil, and it looks like we're about to run out of oil. But a funny thing happened. We didn't run out. And it wasn't because we suddenly discovered these massive new oceans of oil. It's because we got smarter. We became way, way more efficient. And the change was just staggering. Through conservation and better technology, we basically doubled what we could get out of the energy we already had. Just think about that for a second. We grew our energy wealth not by finding more supply, but by cutting our demand in half, just by being smarter. And check this out. This really puts it in perspective. A giant, heavy Chevy Suburban from just a few years ago gets the same, actually slightly better, gas mileage as a regular old family sedan from 1989. That is a wild leap in efficiency. We're doing so much more with less. And that, right there, is the link back to your money. Look, trying to find new oil fields or trying to predict what the stock market is going to do next year, that's almost completely out of your control, right? But increasing your personal savings rate, improving your own financial efficiency, that is 100% in your control. It's the only piece of this wealth puzzle that you can absolutely count on. Okay, so if saving is so powerful and it's something we can actually control, why is it so darn hard for so many of us? Well, the reason is that the real fight isn't with your paycheck or your bills. The real fight is inside your own head. It's a battle between your ego and your income. Let this one sink in for a second. Saving is simply the gap between your ego and your income. I mean, think about it. Once your basic needs are met, food, shelter, the basics, so much of our spending is just about showing other people that we have money. It's about signaling. Saving, then, isn't about depriving yourself. It's about humility. It's about choosing to create a gap between what you could show off and what you actually spend. So the path to saving more money doesn't actually start with spreadsheets and budgets. It starts with raising your humility. It's a total psychological shift. You see it right here. You spend less because you start to desire less. And you desire less because you genuinely, truly stop caring what other people think about your car or your house or your clothes. That's the real work. So we get it. Saving is controllable, it's powerful, and it's an internal game. But what are we even saving for? I mean, really? Because the answer, it's usually not what we think it is. Yeah, of course, we save for the obvious stuff. A down payment on a house, a new car, a nice vacation. Those are the tangible goals we all have on our list. But the real payoff of saving is something completely different. The real life-changing return on your savings is all the stuff you can't see, the intangible things. Saving money just for the sake of having savings, it buys you freedom. It buys you options. It buys you the ability to say no to a bad job, to change careers, to wait for a great opportunity instead of being forced to take the first thing that comes along. It buys you a buffer against the chaos of the world. It buys you peace of mind. And this quote just says it perfectly. When you save, you are literally buying your future self back. You are taking moments and decisions that would have been owned by your boss, or a bill collector, or just plain bad luck, and you're handing them back to the person who should own them, you. What better return on investment is there than that? In this idea, this flexibility you buy with savings, it has never, ever been more important than it is today. In the world we live in right now, flexibility is the new superpower. Think about it. 100 years ago, your competition was the guy down the street. Maybe you were the best lawyer in your town, and that was enough. But today, the world is flat. It's hyper-connected. You're not just competing with people in your town anymore. You're competing with the smartest, most ambitious people from all over the planet. And in this new world, just being smart isn't enough anymore. It's not a real advantage when there are millions of other brilliant people out there. The new advantage, the thing that will actually set you apart, is personal flexibility. The ability to learn a new skill when your industry changes, to pivot your career, to wait for the right moment, or even just to have the breathing room to think about a hard problem without the pressure of having to pay next month's rent, that is a true superpower. And it's a superpower you buy directly with your savings. Control over your time is the most valuable currency in the world today. So, there you have it. You build real wealth with a high savings rate. You get that rate not by earning more, but by being more humble. and you use that wealth to buy the single most valuable thing in the modern world: flexibility and control over your own life. And maybe, just maybe, we need to stop being so rational about what looks good on paper. So I'll just leave you with this. Are you building your wealth to impress other people, or are you building it to free yourself?
All right, let's just jump right in. We're going to talk about an idea today that I think could really change how you look at your money, at risk, maybe even at yourself. And the core idea is this. When it comes to your finances, being reasonable is so much more important than being rational. It sounds simple, I know, but trust me, the implications are huge.
But before we can even get to the money stuff, we have to take a weird detour. Like a really weird detour into medical history. We're going to talk about a Nobel Prize-winning cure that involved two of the scariest diseases you can imagine. Just hang with me here, I promise this is all going to connect.
Because here's the thing, the fundamental truth we have to start with. You're not a spreadsheet. You're a person. A wonderfully complex, kind of screwed up, and definitely emotional person. And once you really truly accept that about yourself, the whole game of managing money starts to make a whole lot more sense. Okay, so meet Dr. Julius Wagner Jalreg. Back in the 19th century, he was treating patients with narrow syphilis, which, yeah, that was pretty much a death sentence. But he started noticing something strange, a pattern. Every now and then, a patient who got some other sickness, something that gave them a really high, long-lasting fever, sometimes they'd actually recover from the syphilis. So he had this crazy but logical idea. What if he did it on purpose? He started infecting his patients with malaria to give them those fevers. I mean, talk about dangerous. But guess what? It worked. His recovery rate more than doubled. And in 1927, he actually won the Nobel Prize for it. And you know, his hunch was dead on. This isn't just some weird story from the past. Modern medicine totally backs him up. You can go on the Seattle Children's Hospital website right now, and it will tell you that normal fevers are a good thing. It means the body's defense system is kicking into overdrive. And how powerful is that system? Get this. Studies have shown that just a 1-degree bump in your body temperature can slow down how fast some viruses replicate by a factor of 200. I mean, that's incredible. The science is totally clear. Fevers help us heal. So we've established that a fever is actually a pretty amazing tool for fighting off sickness. Now let's make that pivot. Let's go from medicine to money. And you'll see the connection is a lot closer than you might think.
Which brings up a super obvious question, right? If fevers are so good for us, why is our first instinct, and what most doctors do, to immediately reach for the Tylenol or the Advil to bring that temperature down as fast as we can?
The answer is so simple. It's because they hurt. Fevers feel awful, and people just don't want to hurt. That's really it. We don't just go to the doctor to get cured. We go to feel better. We want relief from the aches and the chills, even if all that misery is a sign that our body is doing exactly what it's supposed to be doing. And this is the absolute key to everything. It's the difference between being rational and being reasonable. The purely rational thing to do is to suffer through the fever, because that's the most effective way to fight the infection. But the reasonable approach is to take a pill to stop the pain, because who wants to feel that miserable? We trade a little bit of biological perfection for a whole lot of comfort. And that exact same trade-off happens with our money all the time.
So let's take a look at how this all plays out for what we'll call the reasonable investor. And you'll see this applies to even the smartest people in the room.
Okay, so let me introduce you to Harry Markowitz. This guy literally won a Nobel Prize for creating what's called modern portfolio theory. He's the guy who came up with the super complex, mathematically perfect way to balance risk and return. He is the definition of a rational finance guy. So, how do you think he invested his own retirement money?
He didn't use his own theory. Instead, he said, I visualized my grief. His goal wasn't to maximize his returns on a spreadsheet. His goal was to minimize his future regret. Think about that. That's a purely emotional framework. He was thinking about how he would feel, not what the math said was the single best answer. And so what did he do? He chose a dead simple 50-50 portfolio, half stocks, half bonds. Was it the perfect, mathematically optimal portfolio according to his own Nobel-winning models? Absolutely not. But you know what it was? It was reasonable. It was a strategy that let him sleep at night, and that's a kind of return you just can't measure.
Now let's look at the complete opposite. A study from Yale came up with a supposedly rational strategy for young investors. Here it is. For every dollar you have, borrow 2 more. Put it all in the stock market, and if a massive crash comes along and completely wipes you out, just, start over. On paper, the math actually works out. It says you'll end up richer over the long haul.
But let's be real about what wiped out means. If you're using 2-to-1 leverage and the market drops 50%, which it has several times in history, you lose 100% of your money. It's all gone, every penny. So yeah, the strategy is rational in a spreadsheet, but it is completely, absurdly unreasonable for any actual human being to live through.
And that brings us to maybe the single most important benefit of being reasonable with your money. It gives you the power to just stick around.
We're always told to be cold, to be emotionless about our investments, but that can actually be a huge problem, because if your perfectly rational plan is so scary during a market downturn that you panic and sell everything, well, then it's a totally useless plan. The reasonable investor who has a good enough strategy that they can actually stick with has a massive, massive advantage.
This is exactly why sticking around is your superpower. Just look at these numbers. If you invested in the US stock market for a single day, historically, your odds of making money are basically a coin flip, 50-50. But stretch that out to 10 years, your odds jump to 88%. And at 20 years, historically, they've been 100%. Your biggest edge as an investor is simply time.
So the real takeaway is this. A reasonable strategy, one that you can emotionally handle when things get rocky, is what keeps you in the game long enough for those odds to start working for you. It is always, always better to have a good plan that you can stick with than a perfect plan that you'll end up abandoning.
All right, so for this last part, let's talk about something really important. Giving yourself permission to be a human being with your money, and forgiving yourself for not being a robot.
Think about some of these common things that financial experts call flaws, like investing mostly in your home country. Rationally, that's wrong. You should be globally diversified. But reasonably, it makes sense to invest in what you know and understand. Or how about having a tiny fun money portfolio for picking stocks? Rationally, it's inefficient, but reasonably, if it keeps you from messing with your real retirement money, it's a brilliant idea. These aren't bugs in your system. They're features of being a reasonable person.
And for the final word on this, let's talk about the absolute icon of rational, low-cost, spreadsheet-driven investing, the late, great Jack Bogle, the founder of Vanguard. I mean, if anyone was a model of pure financial logic, it had to be him, right?
Well, not exactly. It turns out Bogle actually invested some of his own money into his son's expensive, actively managed mutual fund. And when someone asked him why he would do that, his answer was just perfect. He said, "We do some things for family reasons." He just admitted that life and money isn't always about what's consistent on paper. Sometimes it's about love and family. It wasn't rational, but it was profoundly reasonable.
So I'm just going to leave you with this one question. Forget what's mathematically perfect for just a second. What's the strategy that feels right to you? The one that takes into account your own fears, your hopes, your desire to not feel regret later? What financial strategy is reasonable enough to help you sleep at night? Because that is probably the best strategy you will ever find.
All right, welcome to The Explainer. Today, we're going to dive into something really fascinating. A paradox, really, that's right at the heart of investing in economics. It all comes down to our relationship with the past and how we try to predict the future.
So let's kick things off with this quote from Scott Sagan, a professor over at Stanford. It's a real head-scratcher at first, isn't it? Things that have never happened before happen all the time. I mean, it sounds like a complete contradiction, but stick with me here, because this little phrase perfectly captures a deep truth about how the world works, especially when money's involved.
We're always told, study history. It'll teach you about the future. And sure, it helps us see patterns and where people tend to mess up. But here's the problem. History is basically just one surprise after another. So how can a record of total surprises possibly be a reliable guide for what's coming next? That's the trap we're going to explore.
And that brings us to this big idea, what we're calling the historians as prophets fallacy. It's a trap that so many of us, especially investors, fall right into. It's this deep-seated belief that just because something happened before, it's a perfect roadmap for what's going to happen next. But in a world that's all about innovation and change, man, that is one dangerous assumption to make. Okay, so here's our game plan. We'll start with this historian as prophet idea. Then we'll get into why investing isn't a hard science. Think when electrons have feelings. From there, we'll hit the two big dangers, the power of outliers, and the classic "it's different this time" trap. And finally, we'll figure out what history really has to teach us. Let's get into it.
Okay, so if we're going to get to the bottom of this historian as prophet problem, we have to start with a really basic question. Why is it that we can predict the movement of tectonic plates with some certainty, but predicting the stock market, that's a whole different ballgame? What's the real difference?
And here's the answer. It's all about what's driving the system. In something like geology, you're dealing with natural laws. They are what they are. Gravity doesn't have an off day. But investing, well, the key ingredient there is human emotion. It's run by millions of people who get greedy, who get scared, who get paranoid, and they're all making messy decisions with incomplete info. That's why predictability is just out the window.
I love this quote from the great physicist Richard Feynman. It just nails it, right? Imagine how much harder physics would be if electrons had feelings. Electrons just do what they do. They follow the rules. But investors, we have feelings. We have hopes, fears, crazy narratives we tell ourselves, and that emotional chaos completely changes the entire game.
So we've established that people make markets messy. Now, let's talk about the first huge danger of relying on the past. We're calling it the power of outliers. Because when you're just looking at averages and past patterns, you miss the most important things of all. The giant, needle-moving events that change everything.
Seriously, think about this for a second. In the last couple of centuries, something like 15 billion people have been born. And yet, you could argue that the entire shape of our modern world, I mean everything, was dramatically altered by just a handful of people you see here. A tiny, tiny fraction of 1% drove the vast majority of what happened. History isn't some smooth, predictable line. It's driven by these crazy, unpredictable outliers.
And these outlier events, these tail events, they don't just pop up and go away. No, they're like the first domino in a massive, insane chain reaction. I mean, look at this. Would you ever connect the 9/11 attacks to the student loan crisis we have today? Probably not, but follow the logic. 9/11 happens, so the Fed slashes interest rates. Those low rates create a housing bubble. The bubble pops, causing the 2008 financial crisis. The crisis destroys the job market, so millions go to college instead, and bam, you've got over $1.5 trillion in student debt. A direct line, all from one single unpredictable moment.
Nassim Taleb pointed this out perfectly when he talked about the Fukushima nuclear disaster. They built that reactor to withstand the absolute worst earthquake they had on record. Seems smart, right? But then a tsunami hit that was bigger than anything in the history books, and that's the whole point. The worst thing that's ever happened, well, when it happened, it had no precedent. It was a complete surprise.
And that's the key takeaway here. This isn't about bad math. It's not a failure of analysis. You can run all the models you want. It's a failure of imagination. It's our inability to really truly grasp that things that have never happened before are not just possible, they're inevitable.
Okay, so that's danger number one, outliers. Now for the second big one, ignoring that the world itself is changing. The famous phrase, "it's different this time." It's not just that surprises happen, the actual playing field is being redrawn under our feet, making all the old maps totally useless.
Just look at how much the game has changed. The 401k, the thing almost everyone relies on for retirement, it's barely 40 years old. Venture capital, the fuel for all of Silicon Valley, it basically didn't exist 25 years ago. The S&P 500 itself is a totally different beast. Tech stocks used to be, well, nothing. Now they're more than a fifth of the whole index. The fundamental rules of how money works have been completely rewritten in our lifetimes.
And you can see this evolution in the economy's basic rhythm. Back in the late 1800s, you could expect a recession every 2 years, like clockwork. Early 1900s, it stretched to about 5 years. And for the last 50 years, we've averaged over 8 years between recessions. The entire system just behaves differently now.
And there's a perfect story that captures this whole idea. It's about a true legend, Benjamin Graham. This guy literally wrote the book on investing, The Intelligent Investor. He's the father of value investing.
So Graham gave people these specific, concrete rules to follow. Here's a famous one from 1972. Don't buy any stock trading for more than 1.5 times its book value. Sounds smart? But here's the kicker. If you'd followed that exact rule over the last decade, you would have owned a portfolio of basically just banks. And you would have completely missed, one of the biggest bull markets in history.
But here's the secret, the thing most people miss about Graham. He wasn't rigid. He knew things changed. As Jason Zweig points out, with every new version of his book, Graham would toss out his old formulas and invent new ones.
The master himself knew his old rules became obsolete. Even Graham admitted right at the end of his life, hey, that stuff I used to do, it doesn't work anymore.
Now, all of this flies in the face of one of the most famous sayings in finance from Sir John Templeton. You've definitely heard it. The four most dangerous words in investing are, "It's different this time." It's the ultimate comeback to shut down anyone who thinks the old rules don't apply.
But I absolutely love this comeback from investor Michael Batnick. He says the 12 most dangerous words are, the four most dangerous words in investing are, "It's different this time." Because blindly assuming nothing ever changes is arguably the biggest risk of all. Sometimes it really is different.
So, after all that, where does it leave us? If we can't use history as a detailed map for the future, what good is it? Well, let's talk about what history actually teaches us when we use it as a guide, not a map.
Here's the trick. History is amazing for teaching us about the big, general stuff. The things that never change, right? Human nature, our relationship with greed and fear, how we panic under pressure. That stuff is timeless. But it's a horrible guide for specifics. It won't tell you what the S&P 500 is going to do next quarter or which sector is going to be hot next year. The further back you look, the broader your lesson needs to be.
And that really brings us to the final, most important lesson from the brilliant Daniel Kahneman. He said, the correct lesson to learn from surprises is that the world is surprising. That's it. The point of studying all the crazy things that have happened isn't to get a crystal ball. It's to become really, deeply comfortable with the idea that we have no idea what's coming next. The biggest economic forces that will shape our lives will be things we have never seen before, and for those, there is no guide.
Welcome to The Explainer. You know, today we're going to talk about something that's, well, it's one of those unbreakable rules of money. It's an idea so powerful it can literally be the difference between long-term success and complete ruin. And yet, so many of us, we just completely overlook it. I'm talking about the absolute, non-negotiable need for room for error. So let me just ask you this. If I told you to go find the single, smartest, most practical lesson about handling your money, where would you even start looking, right? You'd probably think, okay, Wall Street, maybe, or I don't know, some dusty old economics textbook from college. The answer, though, well, it's probably not what you're thinking. Yep, Las Vegas. And no, we are not going there to learn what not to do from the folks hitting the slot machines. We're there to zero in on a tiny, super specific group of professionals who have absolutely mastered a financial lesson that, honestly, applies to every single one of us. Okay, so here's how we're going to break this all down. First, we'll unpack that lesson from Vegas. Then we're going to see how it connects to this timeless investing idea called the margin for error. After that, we'll dig into why we're so bad at this stuff, the overconfidence trap. Then we'll get practical, how surviving is really the key to succeeding. And we'll wrap up by talking about how to plan for the stuff you can't even imagine. All right, so first up, that lesson from Vegas. We're heading to the blackjack table to dive into the surprising and really profound wisdom of professional card counters.
So how does card counting actually work? It's not like in the movies. It's not some kind of magic. It's really just about applied probability. A counter is simply tracking the cards that have already been played, which gives them a better idea of what's left in the deck. The key thing to understand is you never know for sure what the next card is, but you do know if the odds are shifting in your favor or against you, and that's when you decide to bet big or pull way back.
And that right there, that's the whole lesson. The entire strategy is built on one simple, powerful idea: humility. A professional card counter accepts, deep down, that they cannot predict the future perfectly. Even when the odds are stacked in their favor, they know they can still lose the next hand. And that's exactly why they never ever go all in.
And listen to this quote from Kevin Lewis, a real deal card counter. He says you have to have enough money to withstand any swings of bad luck. He knows he's going to lose sometimes. That's just part of the game. So his success doesn't just come from his skill. It comes from having a big enough pile of cash to survive the bad hands so he can still be at the table when the good hands come along. That pile of cash, that's his room for error.
Okay, so let's take this idea out of the casino and bring it into the world of investing. This leads us right to one of the most important concepts ever from the legend himself, Benjamin Graham, the margin of safety.
Just read that for a second. Render the forecast unnecessary. Think about how liberating that is. Graham is basically saying, stop trying to predict the future perfectly. It's a fool's errand. Instead, build such a big cushion into your decisions and your investments that it doesn't matter if your forecast is a little bit off. You'll be okay anyway.
So what is this margin of safety? It's just the gap. It's the space between here's what I think is going to happen and here's the range of bad stuff that could happen where I'd still be okay. It's like having extra fuel in the tank, just in case. It's the buffer that lets you be wrong, hit a few bumps in the road, and still stay in the game.
Okay, this all sounds like complete common sense, doesn't it? Build a buffer, expect the unexpected. So why are we so bad at it? Why do we constantly ignore this obvious wisdom? Well, that brings us to the very human problem of the overconfidence trap.
This is just fantastic. There was a study. They asked people to guess how much over budget a stranger's home renovation would go. And people were like, oh yeah, for sure, 25, maybe 50% over. Pretty realistic, right? But then they asked about their own projects. And suddenly, oh no, mine will be on time and on budget. It's classic. We are brilliant at seeing the need for room for error in other people's lives, but we're totally blind when it comes to ourselves.
So why do we do this? It really boils down to two things. First, we just hate to admit we don't have control, that we don't know exactly what's going to happen. It's uncomfortable. And second, building in a margin for error can feel, well, kind of wimpy. It feels like you're not being aggressive enough, like you're leaving money on the table. And those two feelings right there are a recipe for creating dangerously fragile plans.
Okay, enough theory. Let's talk about how to actually make this work for you. How do we put room for error into practice in our own financial lives?
Let's just stare at this number for a second. -30%. This isn't some crazy once-in-a-lifetime disaster. This is a pretty standard, painful bear market. It has happened many, many times, and you have to assume it's going to happen again. The real question isn't if, it's when. And are you actually ready for it?
And this is the absolute key right here. A spreadsheet can handle a 30% drop. The numbers still work. But can you? Can you stare at your life savings cut by a third and not completely panic? A spreadsheet doesn't have to explain to a spouse why their retirement account just took a massive hit. It doesn't lie awake at 3 a.m. staring at the ceiling. Your emotional ability to handle that stress is the real weak point, and that's where most plans fall apart.
So here's a super practical way to do this. When you're running your retirement numbers, don't use the historical average for stock market returns. Knock a third off of it. Just assume things won't go as well as they have in the past. What does this do? It forces you to save more today. Now, if the market does great, amazing, you'll be way ahead. But if the market has a rough decade, you'll still be on track. You've built your room for error right into the plan.
I love this line from the author Nassim Taleb. This isn't about being scared and hiding your money under the mattress. You can and should take smart risks. What you have to be is completely allergic to ruin, allergic to any single risk that has the power to take you out of the game for good.
Think about it this way. Russian roulette. Statistically, you've got a 5 out of 6 chance of being totally fine. Pretty good odds, right? But the downside? Well, the downside is you're dead. It's not recoverable. The potential upside just isn't worth it. Some financial decisions, especially those involving a ton of debt or leverage, are exactly like that. The risk of ruin, no matter how small you think it is never worth taking.
So planning for a market crash is one thing. We know those happen. But what about the stuff you literally cannot see coming? The risks that are so crazy they'd never even enter your mind. This is where the idea of a margin for safety becomes the most important thing of all.
Let me tell you a crazy story from history. It's the Battle of Stalingrad, World War II. The Germans have this huge reserve force of their best tanks ready to go. The call comes in. They're needed at the front line, now. They run to the tanks, turn the keys, and nothing. Silence. Almost the entire unit was completely useless.
So what happened? Was it a secret weapon? Sabotage? Nope. It was mice. Tiny little field mice had gotten inside the engine compartments while the tanks were sitting there and chewed through all the electrical wiring. I mean, think about that. When you're designing a Panzer tank, varmint control is probably not on your engineering checklist. The biggest risks are always the ones that sound too ridiculous to plan for.
And look, this isn't just some funny old war story. These are the modern-day financial field mice that can wreck a plant. An office building floods, a key founder has a mental breakdown, a sophisticated email scam tricks you during a critical transaction. These are the things that no spreadsheet can predict, but they happen all the time, and they can be absolutely fatal to a business or a personal financial plan.
And that really brings us to the final, most important point. The most critical part of any plan you make is to accept, from the very beginning, that your plan will not go according to plan. And your best defense? Your ultimate room for error? It's just plain old savings. Cash. Not savings earmarked for a down payment or a new car. I'm talking about cash that has no job other than to sit there and protect you from a future you cannot predict, to protect you from all the financial field mice out there. So as we wrap up, think about that. Don't just ask yourself, what am I saving for? Ask yourself, what is my savings going to save me from?
You know, have you ever found an old journal or a document where you'd mapped out your 5-year plan and you just have to laugh? Yeah, life almost never goes the way we scripted. Our goals, our ambitions, they have this funny way of shifting right when we think we've got it all figured out. And that's what we're going to get into today. Because the one thing you can absolutely plan on is that you're going to change. So to really get this, I want to tell you a story. It's about a good friend of mine, and it's a story about what it means to achieve the impossible and what happens when the confetti settles. I grew up with this guy, and I'm telling you, he was the single hardest working person I have ever met. Seriously, he didn't come from a wealthy family. He wasn't some kind of born genius. He was just pure, relentless grit. From the time he was maybe 15, 16 years old, he had one single mission in life. He was going to become a doctor. And look, to say the odds were stacked against him, well, that's putting it really, really mildly. Nobody would have bet on him. But he didn't care. He just bulldozed through every single obstacle. For years and years, he just kept pushing. And he did it. He actually became a doctor, a full decade older than everybody else in his class. Just an unbelievable achievement. A few years back, I finally got the chance to catch up with him. And I was so excited, you know? I wanted to hear how this incredible, hard-won dream was treating him. I mean, he made it. So I asked him, man, how is it? How's it going? He didn't even let me finish the question, just looked at me and said, awful career. And he wasn't joking, he said it again. Awful career, man. He then spent like the next 10 minutes just telling me how the insane stress and the brutal hours had completely ground him into dust. He seemed as profoundly unhappy with his life now as he had been driven to get it 15 years before. And, you know, his story just perfectly captures this core human truth. It's really easy, it's actually fun to daydream about a goal. But to imagine that goal in the real world, with all the stress, the commute, the long hours, the office politics, that's a completely different thing. And it turns out we are just terrible at forecasting who our future selves are going to be and what they're actually going to want. Now, my friend's story, that's not some one-off thing. It's actually a pretty dramatic example of a path that almost all of us walk. See, our dreams, our desires, they're not set in stone. They're constantly evolving our entire lives. Just think about your own life, right? When you're 5 years old, driving a giant tractor seems like the absolute best job on the planet. Vroom, vroom, that's it, that's the dream. But by 18, that's probably changed to something with a little more prestige, maybe a lawyer. So you map it all out. The right college, law school, big firm, success. Then you hit your mid-30s. Maybe you've got a family, and suddenly those 80-hour work weeks mean you never see your kids. So you pivot. You find a different job, one with more flexibility. But then you hit 70, and you look back and realize that a whole lifetime of pivoting might have left you totally unprepared for what's supposed to come next. And this isn't just a feeling we all have. There is actual data that backs this up. The Federal Reserve actually looked into this, and they found that only 27% of college graduates work in a field that's even related to what they majored in. Now, that doesn't mean the other 73% regret going to college, but it's a huge reminder that the plans we make when we're 18 often have very little to do with the life we're actually living at 35. Why? Because the person choosing that major is just not the same person who's raising kids 2 decades later. So, this brings us to the really big question, right? If you accept that your goals, your wants, your priorities are all going to change, then how on earth are you supposed to make a long-term financial plan? How do you plan for a future version of yourself that you haven't even met yet? Well, luckily, we are not the first people to wrestle with this exact problem. Psychologists have been studying this for a while, and they've actually given it a name. It's called the end of history illusion. And here's what it is. We can all look back 10 years ago and say, wow, I was a totally different person back then. We see our past growth so clearly. But at the very same time, we tend to believe that the person we are right now, today, is the finished product. We think our personal evolution has just ended. Harvard psychologist Daniel Gilbert put it perfectly with this quote. He points out that young people will spend a ton of money to get tattoos removed, that just a few years earlier they spent a ton of money to get. Middle-aged people rush to get divorced from the exact same person that, as young adults, they rushed to marry. We are constantly making these huge, life-altering decisions for a future self who might not be very happy with our choices. And what's really wild about this, what Gilbert's research shows, is that this isn't just some mistake young people make. It's a cognitive blind spot that sticks with us our entire lives from age 18 all the way up to 68. See, at every single stage of your life, you feel like you've just now become the real you. And at every single stage, you're wrong.
So this isn't just some fun little psychological quirk to talk about. This illusion, it has a real, tangible, and often massive financial cost in our lives.
The legendary investor Charlie Munger famously said that the first rule of compounding, you know, that amazing force where your money makes money, and then that money starts making more money, is to never, ever interrupt it if you don't have to. You just have to let it cook. But what happens when our constantly changing desires force us to do that exact thing? Well, you end up with two totally different paths. On one side, you've got someone like a Warren Buffett. His incredible success comes from doing basically the same thing for decades and letting that power of compounding just run wild. But for most of us, life isn't one long 80-year career. It's more like 4 separate 20-year lives packed into one. We change careers, we start a side hustle, we move across the country. And every time we make one of those big life changes, we interrupt that beautiful compounding process. And in a way, we have to reset the clock. Okay, so we've laid out the problem we are guaranteed to change, and that change can be really, really expensive. So what do we do about it? How in the world can we plan for a future that's so uncertain, especially when the biggest unknown is us? Well, the advice seems to boil down to 2 key principles for navigating this whole thing. First, we need to avoid the extremes. And second, we have to learn to embrace the fact that we're going to change our minds. Let's break that down a bit. So that first rule is really all about balance, because extreme plans, well, they're brittle. They break easily. If you decide to save 90% of your income, you risk having no flexibility for life's surprises. If you decide to work 100 hours a week from a monster salary, you risk burning out and waking up at 40 filled with regret. Both of those extremes often lead to these huge, dramatic, and costly life changes. But a balanced approach, moderate savings, moderate free time, a commute that doesn't make you want to cry, that encourages endurance. It's a plan you can actually stick with for the long haul, even as you change and evolve as a person. The second rule is about being willing to cut ties with the past. It's amazing how many people feel trapped by a decision they made when they were, 20 years old. They stay in a career they absolutely hate. Why? Because that's what they majored in. They're letting a complete stranger, which is who their past self is, make critical decisions for the person they are right now. This reminds me of this incredible story about the Nobel Prize-winning psychologist Daniel Kahneman. When he was working on a book, he would sometimes spend weeks, even a month, perfecting a chapter, and then just delete the whole thing and start over. And when someone asked him how he could just blow up all that hard work, he gave this amazing answer. He said, "I have no sunk costs." He refused to let the effort he'd already put in dictate what he should do next. He wasn't a prisoner to his past self. And man, that is such a powerful way to think. So really, here's the bottom line. Instead of locking yourself into a rigid 5-year plan for a future you that doesn't even exist yet, build a plan that gives them room to breathe, room to grow. Avoid the extremes that are just going to lead to regret, and find the courage to walk away from sunk costs when a path just isn't right anymore. Because the person that you're going to be in 10 or 20 years, they're counting on you. So what choices are you going to make today to give them the best possible shot at a happy life? Everything in life has a price. It's one of those fundamental rules, right? But here's the problem. The most important prices, they're almost always hidden. You don't see the price tag until the bill is way overdue. So today, we're going to pull back the curtain and uncover the hidden price of success, especially when it comes to the world of investing. Okay, so to really get our heads around this, let's start with a story. I want you to picture this. The year is 2004. There's this one company that is an absolute titan. I mean, a true giant of capitalism. For about a decade, it was either the biggest or second biggest company in the entire world, worth a staggering $1/3 trillion. And that company was General Electric. And then, almost in the blink of an eye, it all just fell apart. Back in 2007, the stock was humming along at around $40 a share. Then, of course, the 2008 financial crisis hit, and GE's huge financing arm just went into a total tailspin. By 2018, the stock had completely collapsed to just $7. A giant had fallen hard. And you can probably guess who got all the blame, right? The CEO, Jeff Immelt. The criticism was absolutely brutal. But as he was on his way out, he said something that really truly gets to the heart of what we're talking about today. He said, "Every job looks easy when you're not the one doing it." And man, was he right. From the outside looking in, all you see is the corner office. You don't see the brutal challenges, the bureaucracy, the regulators, the insane pressure for short-term results. It's a completely different world when you're the one in the arena. And that leads us perfectly into our first big idea here, the hidden price of success. What that whole GE story shows us is that the real cost of doing something great is almost always invisible to everyone on the outside. So why is that? Well, the reason is actually pretty simple. As humans, we're just not that good at figuring out what the true price of success actually is. We see the result, the successful company, the amazing investment return, but we don't see the struggle. We don't see the sleepless nights, the gut-wrenching doubt. And here's the kicker. If you can't even identify the price, you have zero chance of ever being able to pay it. And this is just so incredibly true when it comes to investing. The theory, it sounds so easy, doesn't it? Just buy good stocks and hold them for the long run. I mean, we've all heard that a million times. But what's the reality? The reality is you, staring at a screen, watching your life savings just seem to evaporate during a market crash, and having the sheer guts to not just hold on, but to actually keep believing in the plan. That emotional grind, that battle inside your own head with your own fear, that is the hidden price you have to pay. So if the price isn't in dollars and cents, what is it? Let's dig into what it really means to be paying for market returns. This is the real currency you're paying with. It's volatility, that sick roller coaster feeling in your stomach as your portfolio swings up and down. It's fear, that little voice screaming in your head, "Get out now, this time it's different." It's doubt, that nagging feeling that maybe you made a huge, catastrophic mistake. It's uncertainty, the simple, agonizing fact that nobody has any idea what's going to happen next. And of course, regret, kicking yourself for not buying lower or selling higher. These feelings, they aren't a sign you're doing something wrong. They're the price of admission. Let me give you a simple analogy to make this crystal clear. Let's say you want a brand new car and it costs $30,000. You really only have three choices. 1, you pay the 30 grand. 2, you find a cheaper, used one for a lower price. Or 3, you try to steal it. Now, for 99% of us, option 3 is a non-starter, right? Because the consequences are, they're severe and they're obvious. Now let's apply that exact same logic to investing. You want those great, market-beating returns. Okay, option 1, you pay the price, which we now know is all that volatility and uncertainty. Option 2, you accept lower returns for less risk. That's your used car, think bonds or cash. But what do so many people do? They go for option 3. They try to get the reward for free. They try to get those high returns without paying the price of volatility. They try to steal the car. And guess what? Just like trying to steal a car, this strategy usually ends in a wreck. There was this great study by Morningstar that looked at 112 different tactical funds. These are funds specifically designed to get you the market's upside while magically dodging the downturns. Sounds great, right? But when the very volatility they were built for actually showed up, how many do you think actually worked? Out of 112 of them, only 9 managed to beat a simple, boring old index fund. Trying to get something for nothing almost always blows up in your face. Now, I want to show you the real price of one of the greatest investment home runs of our lifetime. Just look at this number for a second, 94%. What on earth could that possibly mean? Well, it represents the huge, almost unbearable price somebody had to pay for an absolutely mind-blowing return. This is the true cost of that incredible return. Between 2002 and 2018, Netflix stock went up a life-changing 35,000%. But here's the price you had to pay. On 94% of all trading days during that period, the stock was trading below a previous all-time high. I want you to just let that sink in. To get that reward, you had to feel like you were losing money almost every single day for 16 years. That was the price. This all builds to what I think is the single most important mental shift any investor can possibly make. It's all about learning to see the price as a fee, not a fine. And it brings up a really fascinating question, doesn't it? I mean, we willingly pay for things we want all the time. We don't try to get a free house or a free car or a free vacation. So why do we try so desperately to avoid paying the price for good investment returns? Well, the answer comes down to this one crucial, simple distinction. We mistake the price for a fine. Think about it. A fine is a penalty. It means you did something wrong and you're supposed to avoid it. But a fee? A fee is totally different. That's just the cost of admission for something you want, something valuable. It's what you expect to pay. But when our portfolios drop, our caveman brain screams, "This is a fine. You screwed up. Sell."
The trick, the mental jujitsu you have to perform, is to stop seeing market downturns as a fine. Instead, I want you to start thinking of market volatility as a fee. And the best way to do that is to think of it like the price of a ticket to Disneyland.
Seriously, think about it. A ticket to Disneyland is what, over $100 a day now? Does anyone show up at the gate and complain that they're being fined for entering? Of course not. It's the fee you happily pay for a day of fun and incredible memories. Market volatility is exactly the same thing. It's simply the admission fee for the chance to earn the long-term returns that will help you build real wealth. So where does all this leave us? What's the big takeaway here? It's really simple. It's our final section, find the price, and then pay it. You have to accept this as a fundamental law of finance. Market returns are never, ever free. They will demand a price, just like any other product you want to buy. Now, you're not forced to pay it, but you sure as heck can't get the product for free. And the good news is, you get to choose which fee you're comfortable paying. You don't have to go to Disneyland. You can go to the local park for free and still have a great time. In investing, cash and bonds have a very low fee, meaning very low volatility, but they also have low potential returns. Index funds, maybe that's like a weekend trip, a medium fee for a medium potential return. And then high growth stocks like Netflix, that's your trip around the world. A very high fee, but with a potential for a very high return. You get what you pay for. So this is the ultimate question it all boils down to. It's not enough to just know that the price exists. You have to look yourself in the mirror and ask, when the market is crashing and everyone is panicking, when that bill for volatility comes due, are you truly willing to pay it? Can you really see it as the fee for future returns and not a fine for a past mistake? Look, don't waste your time looking for a free lunch, because I promise you it does not exist. Instead, do the hard work. Figure out the real price of what you want in your career, in your life, and especially in your portfolio. And then find the courage to pay it.
You know, financial bubbles are they're devastating. They're not just numbers on a screen. We're talking about lives ruined, savings completely wiped out, scars that can last for generations. So today, we're going to try and unravel one of the biggest, most frustrating mysteries in finance. Why do these catastrophic events keep on happening?
I mean, just think back to the dot-com bubble. When that thing imploded, it vaporized an incredible $6.2 trillion in household wealth. And that's not just some Wall Street number. That's people's retirement funds, their kids' college savings, just poof, gone.
And then, believe it or not, just a few years later, it happened all over again. The 2008 housing bubble burst, and it ripped away an even bigger chunk of wealth, over $8 trillion. The sheer scale of that destruction is almost impossible to get your head around, and it leads to one very frustrating question.
Seriously, why? After seeing all the damage, after living through the fallout, how do we keep finding ourselves in the exact same spot over and over again? The lesson seems so obvious in the rearview mirror.
Now, the easy answer, the one we all jump to, is just greed, right? We say people get greedy, they lose their minds, and that's the end of the story. And yeah, sure, greed it's part of the picture. But honestly, it's kind of a lazy explanation that stops us from really understanding what's going on, and it stops us from learning the real lesson.
This is what's so interesting, right? This idea. No one wakes up in the morning thinking, you know what? Today I'm going to make a completely insane, irrational financial decision. No way. In that moment, with the information and the incentives they have right in front of them, their actions make perfect sense to them. So if it's not just about people being greedy or crazy, what is actually driving this cycle?
All right, so this brings us to the real culprit. The theory we're digging into today is a really powerful one. Bubbles don't just happen because of greed. They happen when investors who are all playing completely different games with different rules and different goals start taking their cues from each other. Imagine a stadium where one team is playing soccer and the other is playing baseball on the same field. That's exactly what's happening in the market. And this, right here, is the absolute heart of the matter. We all kind of assume there's one single rational price for an asset, like a stock or a house. But there isn't. The right price for you to pay for, say, Google stock depends entirely on your time horizon. Are you going to hold it for 30 years, or are you trying to unload it before lunch? Those are two completely different prices.
And this slide lays it out perfectly. The two main players on the field. On the left, you've got the long-term investor. They're like a gardener, carefully watering their investment, thinking about decades of growth, a company's fundamental value. On the right, you have the short-term trader. Their time horizon isn't years, it might be minutes. They don't care about a company's balance sheet. They care about momentum and what the crowd is doing today. Two totally different games.
Okay, so let's put this theory to the test. Let's look at a real-world example, our first case study, the dot-com bubble. This is the perfect example of these two different games colliding on a massive, massive scale.
I mean, we all look back at something like Yahoo's valuation back in 1999 and we just shake our heads, right? As the slide says, that was crazy, a zillion times revenue. From the perspective of a long-term, fundamentals-based investor, paying that price was absolute madness. The numbers just didn't add up.
But here's the thing. The day trader, the person surfing that wave of momentum, they couldn't care less about fundamentals. For them, the game was dead simple. Can I buy this stock right now and sell it for a higher price in the next hour? As long as the answer was yes, that crazy valuation was completely irrelevant. For the game they were playing, it was a perfectly rational move.
And this, right here, is the key. This is how bubbles really form. It's not just about prices going up. That's only the symptom. The real, underlying cause is a shift in who's playing the game. It happens when the short-term momentum traders start to outnumber and out-influence the long-term investors. When that happens, the entire market's time horizon starts to shrink.
And get this, we've got the numbers to back this up. In 1999, right at the peak of the bubble, the average annual turnover for mutual funds was 120%. Let that sink in for a second. That means the average fund wasn't even holding a stock for a full year. The average holding period was only about 8 or 9 months. They weren't investing anymore, they were just trading. The short-term game had completely taken over.
All right, let's move on to our next case study, the housing bubble. Because this wasn't some one-off fluke in the tech world. The exact same dynamic, the shrinking of time horizons, is what fueled the massive housing bubble just a few years later.
It's the exact same logic, just a different asset. If your game is to buy a home to live in for 30 years and raise your kids, paying a wildly inflated price is a terrible financial decision. But if your game is to buy that same house and flip it for a profit in 3 months, well, that inflated price seems perfectly logical, as long as you believe someone will pay even more for it tomorrow.
And again, just look at the data here. It's stunning. The number of houses being flipped, that means bought and sold within 12 months, it didn't just go up, it went up by 5 times between 2000 and 2004. This is a perfect visual of time horizons shrinking dramatically. The market wasn't about home ownership anymore, it was completely dominated by people playing the short-term flipping game.
Okay, so this is where it gets really dangerous. This is the danger zone. We've got these two separate games being played on the same field, and for a while, that's fine. But the real danger, the thing that turns a hot market into a full-blown catastrophic bubble, is the moment these two worlds collide.
Cisco Systems in 1999 is the absolute perfect example of this collision. At its peak, it was valued at $600 billion. For that valuation to make any sense, the implied growth was so high that Cisco would have had to become larger than the entire US economy. I mean, just think about that. It's a mathematical impossibility. For a long-term investor, that is a massive screaming red flag. It's a disaster waiting to happen. But for a day trader, the price was perfectly reasonable because they just needed it to tick up a little bit more before they sold.
And this right here is the tipping point. This is the moment of contagion. The long-term investor, right? He's playing his slow and steady game, and he sees the price of Cisco just going to the moon. He sees the short-term traders making money hand over fist, and he starts to doubt himself. He thinks, wow, maybe I'm the one who's missing something. Maybe they know something I don't. And in that moment, he abandons his own game and starts playing the trader's game, using the trader's prices as his guide. And that is when the bubble goes into overdrive.
So, what do we do with all this? This brings us to the final, most important part. Knowing all this, how do you avoid getting sucked into the vortex? How do you protect yourself when these two worlds inevitably collide? Well, it all comes down to asking yourself one simple but incredibly powerful question.
You have to know without a shadow of a doubt what game you are personally playing. What are your goals? What is your time horizon?
Are you investing for retirement in 30 years, or are you trying to speculate on this month's hot trend? Because they require totally different strategies, totally different mindsets, and totally different sources of information.
And the best way to get that kind of clarity is to get specific. Step 1, understand your time horizon. Are we talking months or are we talking decades? Step 2, define your financial goals. What is this money actually for? A house? Retirement? And step 3, and this is the most powerful one of all, write it down. Create a personal investing mission statement for yourself.
And here's a fantastic example of what that can look like. I am a passive investor, confident that over the next 30 years that growth will accrue to my investments. See? When you read that, you know exactly what game this person is playing. And once you have this level of clarity for yourself, you can immediately see that the daily market chatter, the panic about a recession, or what momentum traders are doing today, it's all just noise from somebody else's game. It's noise that you can and absolutely should safely ignore.
And let's end on this thought, because it's really the whole point of this entire thing. If you don't know what game you're playing, how can you be sure you're not just a pawn in someone else's? Because ultimately, if you haven't defined your own rules, your own timeline, and your own goals, you become incredibly vulnerable. You end up taking cues from people whose goals are not your goals. So ask yourself, what game are you truly playing? Because if you don't have an answer, you just might be playing theirs.
Hey there, and thanks for joining me. Today we're going to dive into a really weird little quirk of the human brain, our strange, almost magnetic attraction to pessimism. I mean, why is it that bad news just feels so much more real and honestly a lot smarter than good news? Let's get into it. You know, this quote from Deirdre McCloskey just perfectly captures it, doesn't it? It's not just that hearing bad news is common, it's that it often sounds more serious, more intelligent. And optimists can easily come off as naive, like they're not paying attention to the risks. But the person warning you about danger, well, you're gonna listen to them. So here's the game plan for today. We're gonna start with why we're so drawn to doom and gloom in the first place. Then we'll nail down what we actually mean by optimism. After that, we'll unpack the 3 big reasons pessimism is just so darn persuasive. We'll also look at why we tend to miss slow, steady progress, what that all means for finding success. And we'll wrap up with a really powerful idea that might just change the way you think about things. Okay, let's jump right in with a story of 2 completely different predictions. This is a perfect example of how our brains are just wired differently for hope versus for doom. So take a look at this. On the left, you've got a prediction from 2008 from a Russian professor. He said the US was going to shatter into 6 pieces by 2010. And this wasn't some fringe idea. The Wall Street Journal ran it. People took it seriously. Now on the right, imagine you're back in 1946. Japan is in absolute ruins from the war. And someone predicts it's going to become a global economic juggernaut. You would have thought they were crazy. And yet, that's exactly what happened. The apocalyptic prediction seemed plausible, while the wildly optimistic but ultimately correct one would have sounded completely absurd. And that's really the heart of it, right? Warnings just work. If someone tells you your favorite stock is about to crash, you're all ears. But if they tell you about some unknown stock that's the next big thing, you're probably going to be skeptical. That's the power of pessimism. It just grabs you. All right, before we dig any deeper into why pessimism is so tempting, it's super important that we're all on the same page about what its opposite, optimism, actually is. So let's be clear, real optimism isn't just wishful thinking or believing everything's going to be perfect. That's just being complacent. True optimism is more of a pragmatic confidence that over the long run, things tend to work out. You know there are going to be bumps and bruises along the way, for sure. But it's built on this simple truth that most people wake up every morning trying to make things just a little bit better. And I absolutely love this quote from the late, great statistician Hans Rosling. He reframes the whole thing. It's not about blind faith. It's about being a serious possibilist. It's about looking at the evidence and recognizing our incredible capacity for solving problems and making progress over time. Okay, now we're getting to the main event. Why is pessimism so incredibly seductive? Well, it's not just one thing. It's this powerful cocktail of our ancient brain wiring mixed with the way our modern world is built. It pretty much boils down to these 3 things. First, it starts way back with our evolutionary instincts, that deep-seated fear of losing something. Then, our modern systems, especially money and the media, pour gasoline on that fire. And finally, we fall for this simple mental mistake, where we assume that whatever's happening today is just going to keep happening forever. Let's break them down. Daniel Kahneman, the Nobel Prize winner, put it perfectly.
Our brains are built for survival, not for happiness. For our ancestors roaming the savannah, thinking that rustle in the grass was a lion, even if it was just the wind, was a much better bet than assuming a lion was just the wind. Our brains are hardwired on a better safe than sorry principle, and that makes pessimism our default setting. The second big reason is that money connects all of us. Think about it. A hurricane in Florida is a massive tragedy, but if you live in California, your daily life doesn't change much. But a global recession, that wave can swamp everybody's boat. And because finance is so tangled up, its problems get our universal, undivided attention in a way that very few other things do. And this brings us right to reason number 3, this really simple but very tempting mental error. Check out this prediction from 2008. It's a classic example. You just take a trend, China using more oil, and draw a straight line into the future. The conclusion seems totally logical, inevitable, and frankly pretty terrifying. It feels like we're about to drive right off a cliff. But here's the massive blind spot in that kind of thinking. It totally ignores our ability to adapt. When things get expensive or scarce, it creates this incredible incentive to innovate, to find new solutions, to change our behavior. You know the old saying, necessity is the mother of all invention? Well, it's true. And you want to see proof? Just look at this. The high oil prices back in 2008 suddenly made new technologies, like fracking, profitable. And the result was explosive. U.S. oil production didn't just go up a little bit. It more than doubled in about a decade. The doomsday prediction was just wrong. The market adapted, and we solved the problem. All right, this leads us to our next big idea, because there's another reason we're all so drawn to pessimism, and it's not we have this giant blind spot when it comes to seeing progress. This, right here, might be the single most important idea we talk about today. Growth, improvement. It's a compounding process. It's like a tiny drip of water that eventually fills a bucket. It happens slowly, quietly, over years. But a setback, a market crash, a natural disaster, that's a lightning strike. It's sudden, it's loud, and it makes for a much easier story to tell. I mean, the story of the airplane is the perfect case study. The Wright brothers first flew in 1903. For almost 5 years after that, they were flying all the time, and the world basically just yawned. People thought it was a hoax. Then, in 1908, the world finally started to wake up to this miracle. But what really made headlines? In September of that year, the very first fatal crash happened. That got immediate, widespread attention. The slow miracle was ignored. The fast tragedy was news. Now let's look at a modern miracle that has happened right under our noses. Since the mid-1960s, the death rate from heart disease in the US, when you adjust for age, has fallen by more than 70%. That is an unbelievable triumph of medicine and public health. And to really wrap your head around that number, it's like saving the entire population of a city like Atlanta. Imagine if a headline came out every single year that said, "Atlanta spared from total destruction." You'd notice, right? But because this miracle happens quietly, one person at a time over decades, this incredible achievement barely makes a ripple. So, okay, the psychology is fascinating, but what's the real-world lesson here? How does knowing all this actually help us when it comes to things like investing or building a business or even just our careers? It all comes down to this asymmetry. You spend a lifetime building a reputation, one dumb email can wreck it. The market can double over 6 years and it's just business as usual. But let it drop 40% in 6 months and suddenly there are congressional hearings. The big takeaway is this: the price you have to pay for long-term growth is the stomach to endure short-term pain and a constant stream of pessimistic noise. That's the cost of admission. All right, let's bring it home. I want to end by shifting gears a little from the psychology of it all to a more philosophical idea about how we can manage our own expectations in a world that is just obsessed with bad news. This quote from Stephen Hawking is just so incredibly powerful. He was diagnosed with a terrible disease at 21, told he only had a couple of years to live. And maybe this gets at the deepest reason we're so seduced by pessimism. Maybe it's a shield. It's our way of protecting ourselves from the pain of disappointment. So I'll just leave you with this question to think about. We know pessimism can feel smarter, we know it grabs our attention, and we know it can feel like a safe harbor from disappointment. The question you have to ask yourself is, how is this powerful, seductive bias shaping the stories you tell yourself about your own future? Thanks so much for watching.
Welcome to The Explainer. Today, we're diving into a really fascinating puzzle: How can an economy completely collapse when, physically, almost nothing has changed? It's a question that, I think, reveals the most powerful and yet totally invisible force shaping our world.
All right, let's really get into this with a little thought experiment. Picture this. An alien economist is sent to study planet Earth. Its mission is to make sense of our economy, and it's looking specifically at the years between 2007 and 2009.
So, our alien flies over our planet, and it's taking inventory. It sees the same office buildings, the same factories, the same highways. It scans our universities, it catalogs our patents, and it measures our collective human knowledge. It even notes that, hey, in 2009, our technology is objectively better. You know, we've got faster computers, more advanced medicine, and the first iPhones are starting to pop up everywhere. From its perspective, all the physical tools for creating wealth are still there, totally intact, and even improved.
So logically, it concludes the economy must be booming, maybe even more so than before. But then, it looks at our data, and it is absolutely baffled. Because the physical reality and the economic reality were telling two completely different stories.
First, it sees that U.S. households are a staggering $16 trillion poorer in 2009 than they were just 2 years earlier. That's a number so large it's almost hard to wrap your head around.
And look, this wasn't just some abstract number on a spreadsheet. An additional 10 million Americans had lost their jobs. The stock market was worth half of what it was. People's optimism, their faith in the future, it had just evaporated. So the alien is stumped. Nothing tangible was destroyed. So what on earth happened?
Well, our alien was baffled because the one thing that had fundamentally changed was completely invisible to its instruments. It wasn't a physical change at all. It was psychological.
That's it. That's the answer. In 2007, we as a group believed a story about the stability of housing prices, the prudence of bankers, and the idea that markets were infallible. By 2009, we just stopped believing that story.
Now, this is completely different from tangible damage, like when Germany's manufacturing base was destroyed after World War II. In that case, physical things had to be rebuilt. But in 2009, we inflicted what you could call narrative damage on ourselves. We had the exact same capacity for growth, but we lost the faith that actually powered it. And you can just see the chain reaction play out perfectly. Once that powerful story that home prices always go up broke, the dominoes started falling in the real world. Defaults spiked, which made banks terrified to lend money, and without loans, businesses couldn't expand, so they had to start laying people off. Then, as people lost their jobs, they stopped spending, which of course led to even more layoffs. The story changed first, and the tangible economy followed, triggering the worst economic crisis in 80 years.
So the crucial point here is that narratives aren't just fluff. They are the operating system for our economic hardware. They are the fuel that lets all those tangible assets, the factories, the computers, the knowledge, to actually work. Or they're the brake that can bring everything to a grinding halt.
Okay, so if stories are that powerful, we really have to understand why we as humans are so susceptible to them, especially when our money and our futures are on the line.
This points to a fundamental bias in our own psychology. The more we want something to be true, especially when the stakes are really high, the more likely we are to believe a story that supports it, completely overpowering our rational side. And this has a huge impact on our financial decisions.
Think about the Great Plague in London. People were so desperate they started buying infallible preventive pills from street quacks. Or consider a father in a remote village whose son is gravely ill. He told a reporter he'd believe anything that offered a chance of a cure. I mean, when the stakes are that high and your control is that low, you'll believe almost any story that offers even a glimmer of hope.
Now let's see how this exact same psychology plays out in modern finance. Take a look at the performance of actively managed mutual funds. Over a 10-year period, a staggering 85% of them failed to beat their own simple market benchmark. The hard data is overwhelming that most of them just don't deliver on their promises.
And yet, people have poured trillions of dollars into these very funds. Why? Because the story, the appealing fiction of finding that one brilliant manager, that next Warren Buffett, who can make you rich without any effort, is just too powerful to resist. The stakes feel so high that we believe the story over the statistics.
So beyond these appealing fictions that other people tell us, there's another, more personal reason we rely on stories. And it has to do with the fundamental limits of our own knowledge, and just how our brains cope with uncertainty.
Think about a 1-year-old child. She has no concept of a career, a mortgage, or the Federal Reserve.
Her knowledge is incredibly limited, but her world isn't chaos. She creates a simple, coherent story based on what she does know. Dad isn't playing with me, and that makes me sad. Here's the thing, we never outgrow this. As adults, we take the tiny fragments of information we have and weave them into a story that makes sense to us, filling in the enormous gaps of what we don't know.
This is where the work of psychologist Daniel Kahneman is just so insightful. He explains that this tendency to create these neat stories about the past is incredibly dangerous. The ability to look back and build a plausible story about why something happened gives us this powerful illusion that the world is predictable. And this illusion makes us wildly overconfident about our ability to predict the future.
We get into real trouble when we confuse fields of uncertainty, like investing, with fields of precision, like rocket science. I mean, NASA can predict a trip to Pluto with almost perfect accuracy because, well, the laws of physics don't have feelings. But investing is driven by fear, greed, and the unpredictable stories swirling inside millions of people's heads. We want it to be a trip to Pluto, precise and controllable, but it just isn't.
So Kahneman identified these common mental shortcuts, or traps, that just reinforce our overconfidence. First, we tell ourselves stories where our successes are due to skill, but our failures are just bad luck. Second, we build our entire worldview on the tiny sliver of information we actually have, ignoring the vast ocean of what we don't know. And finally, we tell ourselves a story where we're the main character, totally ignoring the plans and skills of our competition. All of these traps make us feel like we're in control.
So, this is all a bit humbling, isn't it? If we're all driven by these invisible stories and we're constantly filling our massive knowledge gaps with comforting but often flawed fictions, how can we possibly hope to make better decisions with our lives and our money?
Well, the single greatest protection against a world run by stories is to build a buffer. This means creating a gap between what you need to happen for a good outcome and what could plausibly happen in reality. The more you want a particular story to be true, the wider your margin for error needs to be. And this applies to everything, your savings, your investments, even your career timeline.
I love this quote. A margin for error isn't about planning for the risks you can see. It's about protecting yourself from the stories you don't even know you're telling yourself, the blind spots, the unknown unknowns. It's humility built right into your strategy.
And that brings us right back to our alien economist. It was confident it understood our economy based on the tangible things it could see, but it was completely wrong because it couldn't see the narratives inside our heads. And that's the final thought I want to leave you with. That alien is us. Recognizing that we are all that alien, operating with incomplete information and driven by powerful stories is the first and most crucial step toward wisdom in a story-driven world.
You know, sometimes the best lessons come from the most unexpected places. Today, we're going to talk about a pretty horrifying story from medical history that, believe it or not, has an incredible amount to teach us about how we manage our money. It all starts in a dentist chair, almost 100 years ago.
Okay, I know what you're thinking. A dentist from the 1930s? What on earth could that possibly have to do with my 401k or my savings account? But stick with me here, because the answer might just completely reframe how you think about every financial decision you make. So our story kicks off in 1931. It's about a man named Clarence Hughes, who had a dental appointment that went horribly, tragically wrong. Picture this. He's in absolute agony. He goes to his dentist, who does what was pretty common for the time, puts him under a general anesthetic to figure out what's going on and get to work. I mean, can you even imagine that? He goes in for a toothache and wakes up hours later to discover the dentist had, on his own authority, pulled 16 of his teeth and, for good measure, took out his tonsils too, all without a single word of discussion or consent. And the worst part? The complications from these massive, unsolicited surgeries were just too much for his body to handle. A little over a week after that dental visit, he was dead. A trip to the dentist ended in tragedy. But the legal fight that came next is what really changed things.
So you'd think this is a clear-cut case of malpractice, right? Well, not exactly. Back then, surgery was just incredibly risky. Instead, his wife sued on a totally different principle. Clarence never consented to any of it. But here's the shocking part. The courts actually sided with the dentist. Their reasoning was that doctors needed the freedom to act in the name of scientific progress. The patient's opinion just wasn't the priority.
And this whole terrible story, it perfectly captures the medical mindset of that era. It was a time when the doctor was king, and the patient, well, the patient was just there to be fixed.
Dr. J. Katz had a name for this. He called it the silent world between doctor and patient. The idea that you, as the patient, should have a say in your own treatment, it just wasn't even on the table. The doctor knew best, and that was that.
This whole approach was called paternalistic medicine, and it was built on two fundamental, and as we now know, flawed assumptions. First, that every single patient wants the exact same thing to be cured. And second, that there is one single, universally correct way to achieve that cure. I mean, if you truly believe those two things, why would you ever need to ask the patient what they think?
But thankfully, things had to change. Over the last half-century, there's been this massive, fundamental pivot in medicine. The goal is no longer just to treat the disease in a body, it's to treat the patient, a whole person, with their own values, their own goals, and their own definition of what a good outcome actually looks like.
And this is where it all circles back to you and your money. Let's build that bridge from the dentist's office in 1931 right to your financial life here and now.
Just think about it for a second. Medicine and financial advice are way more similar than you might think. Are the stakes really high in both? You bet they are. Is the subject matter pretty complex and sometimes confusing? For sure. And here's the big one. Do individual goals, risk tolerances, and desires differ wildly from one person to the next? 100% yes. Just like two patients with the same illness might choose totally different treatment plans.
And that is exactly why nobody, including me, can tell you the one right thing to do with your money. I'm not going to be that 1930s dentist imposing my idea of a cure on you. Because the simple truth is, I don't know you. I don't know what you truly want out of life, or when you want it, or, most importantly, why it matters to you.
But hold on. Just because there isn't one single right answer for everyone doesn't mean we're just stumbling around in the dark. Not at all. There are some timeless truths, some powerful guiding principles that can act like a compass to help you make your own best decisions.
Let's start with the foundation of it all. I call it the sleep at night test. Seriously, forget what the talking heads on TV are saying. Forget what your neighbor is doing. The best guidepost for every single financial decision you make is asking yourself, does this allow me to sleep peacefully at night? For some people, that means aggressively chasing high returns. For others, it means the comfort of conservative, safe investments. There is no right or wrong here, there's only your answer.
Here's a really powerful way to reframe what saving is all about. It's not just a math problem, it's a psychology game. Real wealth is often what you don't see. It's the fancy car you didn't buy, the expensive watch you passed on. Saving is simply the gap between your income and your ego. It's about taming that desire to show off today so you can have more choices and more freedom tomorrow.
Okay, listen up, because if there's one cheat code in all of finance, this is it. The single most powerful thing you can do as an investor isn't picking the perfect stock or timing the market. It's increasing your time horizon. Time is the magic ingredient. It's what turns small sums into fortunes and makes even your big mistakes fade into the background.
All right, let's look at a few more of these principles. And these aren't about getting rich quick. This is about building the kind of wealth that lasts, the kind that gives you real, genuine resilience in a world that's always throwing curveballs.
So why are we even doing all this saving and investing? What's the real point? It's not about having a bigger number in an account just for the sake of it. The highest dividend money will ever pay you is control over your own time. The ability to wake up in the morning and do what you want, when you want, with the people you want, for as long as you want. That freedom, that is the ultimate prize. You have to understand that success in investing has a price, but it's not always obvious. The real cost isn't just in dollars, it's in dealing with the gut-wrenching feelings of uncertainty, doubt, and regret along the way. But here's the mental trick. You have to stop seeing those feelings as a fine for doing something wrong. Instead, see them as the fee, the price of admission you willingly pay to get the incredible long-term returns. This leads right to another crucial idea. You need to worship room for error. What that really means is building a buffer, creating a gap between the absolute bare minimum you need to happen for your plan to work and what could happen in a crazy world. That gap isn't being pessimistic. It's what gives you endurance. It's the shock absorber that keeps you in the game long enough for compounding to work its magic.
Which brings us to our final, and maybe the most important idea of them all. It's time to stop looking at everyone else's race and focus on your own.
You know, after everything we've talked about, from a horrifying dental surgery to the magic of compounding, it all boils down to this one simple, powerful idea. There is no single right answer. There's just the answer that works for you. And so that's the question I want to leave you with. Forget all the noise. Forget what other people are doing.
What's the one rule you need to follow for the financial game you're playing? Because once you know your own rules, you've already won.
Welcome to The Explainer. Today we're going to get a little bit personal. We're not diving into spreadsheets or trying to predict what the market's going to do next. Instead, we're going to talk about money as a story, and specifically, your story. It's really all about what you value and ultimately how you want to live your life.
So let's just jump right in with this really powerful question from the billionaire investor Sandy Gottesman. See, when he interviews people, he doesn't ask them for their hot stock tips. He asks them a much simpler question. What do they do with their own money? It's a question that just cuts right to the heart of everything.
And why is that question so powerful? Well, because it reveals this huge gap that you see absolutely everywhere. The difference between the advice people give out and the actions they actually take for themselves. It's theory versus reality, especially when your own hard-earned money is on the line.
Okay, so let's explore this gap a little bit more. Because, honestly, understanding this is the absolute first step to building a financial life that's actually tailor-made for you. One that lets you sleep peacefully at night. This number, it says so much. 50%. According to Morningstar, that is the percentage of mutual fund managers in the U.S. who don't invest a single penny of their own money in the funds they manage for other people. Just think about that for a second. It's pretty wild.
But here's the thing. This isn't really about hypocrisy. It's about human nature, especially when decisions get emotional and really, really complex. And you see the exact same pattern play out in another super high-stakes field, medicine.
And this just illustrates the point perfectly. There was an essay back in 2011 called How Doctors Die, and it revealed that physicians, they often recommend the kitchen sink approach for their patients, every single aggressive treatment possible. But for themselves, it's a completely different story. They overwhelmingly choose palliative, comfort-focused care. They choose to go gently.
So the crucial point is this. The most important decisions in life, whether we're talking about health or money, they are not made in textbooks or on some spreadsheet. No, they're made at the dinner table. They're about minimizing future regret and just feeling secure, not simply maximizing a number on a page.
And this brings us to what I think the real goal is. For me, it has never been about getting rich in that traditional flashy sense. It's about achieving something far more valuable, something that gives you ultimate control over your own life.
The legendary investor Charlie Munger just said it perfectly. It's not about the pile of money itself, it's about what that money can buy you. And the most valuable thing it can possibly buy is independence.
To me, this is the real definition of wealth. It's the ability to control your time. It means doing work you love with people you like for as long as you want to do it. It's the freedom to change your life when you're ready, not when circumstances force your hand.
My own father is a perfect example of this. He became an ER doctor at 40. One of the most stressful jobs you can possibly imagine. But because he and my mom saved consistently for decades, he earned his freedom. And one day, after 20 years in the ER, he just decided he was done. And he stopped. He had the independence to walk away completely on his own terms.
And that kind of freedom, it's not just reserved for high earners. It's accessible at any income level. It's all driven by one simple metric, your savings rate. It's just about the gap between what you earn and what you spend. That's it.
So, how does this all translate into a practical strategy? Well, I want to share what has worked for my family. And I'm not saying this is a prescription, but maybe just one example of finding what feels right for you. My wife and I, we started out with pretty normal entry-level jobs and a lifestyle that was comfortable but, modest. The key was, as our incomes grew over the years, our lifestyle didn't really change. We just got the goalposts to stop moving. And this meant almost every single raise went directly into savings, what we called our independence fund. By avoiding that lifestyle creep, we basically just stepped off the hamster wheel of trying to keep up with everyone else. It's exactly what the author Nassim Taleb is talking about here. We weren't depriving ourselves. We were buying ourselves peace of mind. Now, this led us to what is, on paper, probably the worst financial decision we have ever made. We paid off our house when mortgage rates were incredibly low. A rational financial advisor would have screamed. But for us, it was the best money decision we ever made. The psychological freedom of owning our home outright, that was worth more than any potential return we could have gotten in the market.
Okay, here's another decision that makes spreadsheets cry. We keep about 20% of our assets, outside of our home's value that is, in cash. Yeah,
It's a huge drag on returns, and most financial advisors would argue against it pretty hard.
So why do we do it? Because cash is the oxygen of independence. It's our buffer against all of life's inevitable curveballs. It means that if some big, unexpected expense hits, we never, ever have to be a forced seller of our long-term investments, especially not during a market downturn. And that security, it's priceless.
Now let's talk about the other side of the coin, investing. My philosophy here has also changed dramatically over the years, moving away from complexity and towards just radical simplicity.
You know, back in my 20s, I was an active stock picker. I was always doing research, managing this portfolio of about 25 different companies. Today, oh man, our entire stock portfolio is just a few low-cost index funds. And those are basically just baskets that hold tiny little pieces of the entire stock market. That's it. Simple.
And here's the simple reason why. Trying to outsmart the market is just incredibly difficult. Over the decade that ended in 2019, 85% of professional fund managers, the people who do this for a living, they failed to do better than the simple market average. The odds are just not on your side. So my strategy today really just comes down to a few core beliefs that I can actually control. I focus on a high savings rate. I practice patience to let my investments compound and grow. I have a long-term belief in the world economy. And, maybe most importantly, I accept that in investing, putting in more effort rarely leads to better results. Simplicity is my superpower now.
So after all of this, after all these personal confessions about saving and investing, it all boils down to one simple, unifying idea that I think is true for absolutely everyone, no matter what their strategy looks like.
And it's this: no one is crazy. Your financial decisions are a product of your own unique experiences, your goals, your fears. Paying off a cheap mortgage might seem totally irrational to an economist, but if it helps you sleep at night, then it is the right decision for you. The ultimate goal isn't to be perfectly rational. It's to have a system that works for you, giving you the independence to live the life you want. And that is a strategy that just can't be beat.